Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things that you need to know this morning. UPS shares slump after the delivery giant missed on second quarter revenue and slashed its full year outlook. Revenue guidance now at around $93 billion this year. That is down from a prior forecast of roughly $97 billion. Much of the hit being put down to the impact of labor negotiations. UPS and the Teamsters Union reached a tentative deal on a new contract at the end of July. Union members are yet to approve it, however. These results won't come as a huge shock to investors. At the end of April, UPS warned that volume would remain under pressure due to current macro conditions. Moody's has cut its rating on 10 small and mid-sized U.S. banks and warned it could downgrade bigger lenders as well. There were official downgrades for the likes of M&T Bank, Pinnacle, Webster Financial. 11 banks in total were put on a negative outlook, including larger lenders like PNC, Capital One, and Citizens. Those are all falling in pre-market trading. Bigger plays like Bank of New York Mellon, U.S. Bancorp, and State Street are all under review for a potential downgrade. And the good times keep rolling for Eli Lilly thanks to a strong drug pipeline. The pharma company upping its full year guidance after second quarter profit rocketed 85% from a year ago. It now sees full year revenue landing between $33.4 billion and $33.9 billion. Much of the tailwind coming from its type 2 diabetes drug Mounjaro, which of course is also being used off-label for weight reduction, and breast cancer pill Verzenio. Shares are up 25% this year, and they've outperformed the wider sector. Well, UPS is under pressure this morning after the company cut its full-year outlook, saying that labor negotiations and associated costs will weigh on revenue and operating margins. The package delivery giant missed Wall Street's revenue estimates with about $22 billion, but had better than expected adjusted profit at $2.54 a share. Really, though, in terms of our takeaways, Brad Smith, we're focusing on a couple of different things here. So why don't you kick it off?
Yeah, one of them was international revenue, and we called this out this morning after the earnings dropped here, and potentially a larger headwind that could continue to persist right now from China. If you look through the earnings results from UPS, one of the things that they did talk about was that softness in the Asia market there. So that one of the hits on this most recent quarter and could potentially proceed into the next quarter as well when you consider about some of that weakness and how that shows up in their forecast. You were also keeping an eye on volumes, and before we get to that, the Teamster negotiation, which essentially concluded. I mean, it's still
basically they have to ratify.
Right, has to be ratified.
But it's largely been agreed to. It's just a matter of sort of now putting that final stamp of approval on that agreement. But it's not just the cost directly related to that. It's the fact that some of the clients of UPS put off their orders while they were waiting for these negotiations to conclude. Right. So in terms of that obviously is one of the things that is feeding into this lowered guidance that we talked about. I'm also looking here in the U.S. The company said that domestic revenue was down by nearly 7%. That was because of a 10% drop in average daily volume. At the same time, there was a 3.3% increase in revenue per piece. So even though we have seen the sort of broader conversation among companies, whether it's shippers like this or it's packaged consumer good companies, et cetera, we've seen the volume versus price narrative kind of cool off a little bit because we are seeing some disinflation here, but we're still sort of having that conversation when it comes to UPS. So it's kind of made up to some degree for that drop in volume with an increase in prices, but not all the way.
Yeah, and then one last segment here that really kind of caught the eye this morning was the supply chain solutions segment. This was a dismal quarter for supply chain solutions year over year. You look at some of the declines that came forward, particularly there on a revenue basis and then additionally on the operating profit basis, and a larger question of where they will continue to find some type of demand that is propped up or at least sustained even in a more normalized environment for the supply chain solutions part of their business. Operating profit came in at about $295 million. Compare that to the $513 million that they saw in the same quarter last year. So a significant cut there led some of the overall year-over-year declines on a segment basis for the company.
Yeah, so let's talk a little bit more about UPS and what its results say about the state of the consumer and the U.S. economy. Matt Maley is joining us now. Miller Tabak, Managing Director and Equity Strategist. Matt, it's good to see you. So we look at this UPS results. UPS tends to be seen as an economic bellwether. Is that still the case with all this sort of Teamsters noise? What can we take away from these numbers?
Yeah, Julie, I think it is a little bit concerning about what's going on with the consumer. I mean, yes, we have the situation where they blame most of it on this new contract, but on a on a macro basis, that's not all that great because we worry more about wage inflation and what does that mean for the Fed, and will they keep rates higher for longer, even if they're going to stop, or even if they've already stopped cutting rates. But on the consumer side of things, as you said, the demand was down, revenues are down. I mean, we can talk about their margins might get hurt because of the higher wages, but if revenues are down, revenues aren't impacted by wages, and that tells us that maybe the consumer is starting to pull in their hands. I mean, we saw some news out last week on the domestic travel side from JetBlue, and even though people are going overseas and they're spending time in restaurants and the experiences, they seem to be pulling their hands, pulling their horns in a little bit, and that does get me a little bit concerned, given how important the consumer is for our economy.
Matt, let's stay overseas for a hot second here, because when we think about that international impact that the company talked about in this quarter, saying that the revenue decreased 13%, primarily driven by a 6.6% reduction in average daily volume and continued softness on Asia trade lanes. How much longer do you think that could continue to be a headwind for this company?
Well, I mean, the problem we have is that the slowdown that we've seen in other parts of the world. I mean, Europe seems to be stabilizing, but Asia certainly not. And we have some more news, of course, out of China on their trade numbers that are very concerning, and that of course spills over to the rest of Asia. And with the again this whole idea that we've been harping on for most of this year, that people are spending less money on stuff and more money on experiences. Well, that's fine. But if the experiences are starting to pull back a little bit, and we've already have a problem with people buying material items, that again creates the kind of headwinds that we don't want to see in an economy here that is based 70% based on the U.S. consumer.
At the same time, how should we be thinking about the U.S. consumer? Because as you said, there has been this shift to services from stuff, and yet then you had Amazon, whose stuff is selling pretty well. So it feels like I don't know, it's a little murky right now.
Yeah, no question, Julie. It's not like we're looking at the consumer suddenly imploding, but we do have the. We're just getting a lot of mixed signals. Amazon's been pretty good, but you see what the retailers did in when they reported earnings last time. They have yet to report yet. We'll hear from them in the future here. But their stocks have obviously got pummeled real hard during the last earnings cycle, and of course their guidance wasn't very good either. Their stocks have bounced back a little bit, but that I think seems to be more technical in nature. And again, the concern is not so much that the consumer is going to implode, but it does start to soften with credit card debt at all-time highs and savings rate having come down from the level we saw at the pandemic. I mean, are they going to be strong enough to fuel further gains going forward?
Matt, you mentioned a moment ago how much UPS had kind of leaned into what the negotiations had been like with the Teamsters, how that played out, what that means for the guidance going forward here. Is there anything and this has been a big year for some larger union negotiations, is there anything that we can extrapolate from what UPS and their own negotiations look like and apply that to some of the other kind of employment situation and union negotiations that are still moving forward?
Well, there's no question we're seeing it. The unions and workers overall have more leverage than they used to have, and it's whether you see it in restaurants. We've been talking about it for a couple of years now. Well, now these union contracts, which obviously involve tens of thousands of people, are coming to a head. And look what happened with the pilots unions, getting 40% increases. Mm-hmm. These are very significant, and at some point it's going to have an impact on margins. And the biggest thing we keep talking about, we're going to be able to avoid a recession. That's great, but if earnings don't increase going forward, and with those margins being compressed, if earnings can't increase, that's going to again make it tougher for the stock market to rally as strongly as it has so far this year.
All right, Matt, stay with us. We've got much more to discuss here this morning. In a blow for regional banks, Moody's cut ratings for small businesses, several small and mid-sized lenders, I should say, citing growing profitability pressures in the industry. In its downgrade notes, the agency flagged concerns over commercial real estate risks, possible regulatory capital weaknesses, and higher funding costs fueled by rising interest rates. Several larger lenders, including State Street and U.S. Bancorp, are also under review for a possible downgrade. As Moody's sounds the alarm bells, is the banking industry slipping back into their crisis? That's one of the questions out there this morning. Joining us now, we've got Abby Yoder here in studio with us, JP Morgan Private Bank U.S. equity strategist, and Matt Maley still with us. Abby, I'll go to you first here. As you think about the crisis that we'd moved through earlier this year and now what this potential move signals, is there more uncertainty ahead in that banking sector right now?
I mean, no, I don't think that the ratings downgrades suggest that there's more weakness necessarily coming that we didn't already see. Pointing out these three things around commercial real estate exposure, regulatory capital weakness, deposit costs increasing, those aren't new things, right? Like, these are all have been very well known, and actually we just heard from a bunch of the banks during earnings, and what you did see, particularly on the small and mid-cap size, was that deposit costs went up way in excess of what people were expecting, right? So when we're thinking about it from a profitability standpoint, that definitely is pressured there. And then we have the new Basel requirements. Obviously, this doesn't touch necessarily, that's $100 billion and bigger in terms of the banks, but those are real pressures. But the ratings downgrades, I would say, are kind of rear view mirror. It's similar to the ratings downgrade that we got last week on the U.S. debt. I think the move that we're seeing this morning in regional banks has more to do with the fact that they've rallied so much over the past couple of weeks, right? It's not necessarily, okay, this is new news on the fundamental front. It's more, okay, we've seen valuations expand really because we have seen earnings downgrades. So I think that's more a sentiment move than anything else.
I'm curious about the bond front as well, because obviously the downgrades are directly related to the credit of these companies. Have they already priced in all of these elements that are discussed in the note, or do you get sort of a technical move when you get a debt downgrade like that?
Yeah, I mean, I think that's for the markets to figure out right now. It's going to depend company on company. I think that's reflected in certain shares, but I think overall right now you've seen debt markets very well behaved, right? In the same way, similar to the equity market. So I would imagine you see similar reactions on both the debt and equity side as it relates to the banks.
Matt, I want to bring you back in here. XLF, of course, S&P 500. Financial sector, that was one of the best performers during the second quarter of this year. So you think more moving forward at this point, and some of the downgrades that had come forward either on debt on the U.S. side, but additionally some of the red flags that Moody has raised on some of these small or mid-sized banks here. Is there a little bit more sputtering or any kind of volatility that you're anticipating within the financial sector?
Oh, I think Matt has frozen.
Yeah.
All right, so Abby.
Do I think there's more volatility in the banking sector? I mean, I would imagine that there's more volatility in the market generally speaking, sure. And then this microcosm that happens to be higher beta, yes, probably. And I think right now, when we're looking at the banking sector generally thinking about, okay, do we want to upgrade it, do we not? It's this really, it's a tug of war between valuations, what are they reflecting, because they are very cheap at around a 40% discount to the overall S&P when you're looking at the small and mid cap space. But we haven't even gone through a credit event, not to mention what's going on now, but I mean from like a consumer C&I standpoint, when you think about delinquencies, when you think about net charge-offs, we haven't even gone through that yet, right? And that's like really part of, you want to see the banks go through that and that hit to profitability before you get a little bit more, I guess, positive on them. But then that all leads back to the debate, okay, then what's going on with the economy? Is there a recession or is there not a recession? So it's a very tough sector. And the market generally is tough, and it has rallied a lot over the past couple of months. I mean, up 10% in 2 months. So I think we would definitely see more volatility in the banking sector going forward.
Matt, you still there?
Yeah.
All right,
Sorry,
there he is.
what happened there.
There he is. So talk to us about this, where we stand sort of credit-wise. I mean, we've also seen other murmurings of maybe trouble would be too strong a word, but PayPal, for example, talked about in particular increased provisioning for loan losses. How acute do you think that is going to get, given the economic backdrop in your view?
Yeah, I mean, this is definitely something that we need to be thinking about. I mean, I don't want to say overly concerned, but at the same time, I think whether it be the banks or other financial companies have been, a little bit too complacent too quickly after the banking crisis. I mean, these banks are still lugging these long-term bonds. I mean, it's not like they've sold them. They still have those on their balance sheets. That's a big problem. But, again, we see a 10% rally in just the last month or so, 20% rally in the last 2 months. These banks are getting ahead of themselves, and I think even though they're cheap on a very long-term basis, I think people are getting a little bit too complacent about what we really went through in this spring. And I think Moody's has got people to refocus on the situation.
Okay. We're going to try and get Matt back, but while we still have you, just for a little bit more on this conversation, Abby, I mean, we're looking at some of the regional banks coming into the start of trade here today. What is for anyone who has even tried to look at the regional banks, tried to play a bounce back in them after March and what we'd seen play out? I mean, more largely, there's a question of, all right, how do they manage through this? How do they continue to make sure that customers don't lose confidence in regional banks too?
Yeah, I mean, the confidence issue is something that to the scale that that we saw in March, right, that was really the biggest issue, right? It was a crisis of confidence. It led to an unprecedented outflow in terms of deposits. In terms of when you're looking at the banks now, they are doing the right things. They really are, right? They're raising deposit costs, which, yes, it'll hurt their net income, but they're doing it to retain those deposits, right? There's a reason that they're doing that. And you're also seeing a lot of them restructure their balance sheet. They're not really, they're taking into account the fact that interest rates have had this effect on AOCI and their balance sheet, and they have to, and the new regulatory requirements will actually force them to now take those hits, just like the larger banks do. So I would say overall, looking forward, I think it's a less profitable outlook. So when you're thinking about, okay, if I'm looking at a relative valuation, it looks cheap relative to longer term history, but they're probably going to be less profitable. So you have to keep that in mind. But I think longer term, they'll be in better shape, just like it turned out for the bigger banks over the past decade too.
And I have sort of a bigger question as we look at this downgrade, as we look at the downgrade last week, as we look at the credit sort of backdrop. We look at interest rates having moved higher. In other words, there has been a lot thrown at the market this year. And to your point, with the 2-month 10% rally, the market's like, everything's fine. Is there anything that will not be fine with this market?
Yeah, I mean, I think a lot of things. Well, not a lot of things. Right? It's a different world than I would say back in March. March felt like the depths of, and to keep that in mind, though, the market only hit 38.50 in March. It didn't even really it didn't come close to retesting the lows of October. But I think the biggest thing right now the reason the market is acting the way that it's acting is because we're getting better economic data alongside slowing inflation, and convincingly slowing inflation, right, on the services side, not just on the goods side. And so that's leading to, the market doing what it's doing. And then you add on top of that, we've had 2 really good earnings seasons in terms of relative to expectations in both 1Q and 2Q. So that's why you're seeing the market hold up the way that it's holding up. I think what might derail that is you see inflation start to inflect higher, and then that calls into question, okay, what happens with the Fed? Because what you've seen over the past couple of weeks is, although you've seen the 10-year re-rate higher, you haven't seen front-end yields move, right? So that the expectation in terms of what the Fed is going to do and what that means for the economy ultimately hasn't changed over the last couple of weeks. If the inflation picture changes, we obviously get data tomorrow, and that suggests the Fed has to go even further than they already have. I can see that being a little bit painful for the market.
All right, well, we're going to stay right there. We're going to talk about one more potential fly in the ointment, and that has to do with what's going on overseas, in particular in China. China's trade woes are clouding hopes of a recovery. Imports and exports fell for the world's second largest economy much faster than estimated last month. China's imports down more than 12% in the last year. Exports contracted 14.5%. That grim trade data continues to fuel Wall Street's expectations that China's economic activity could slow further in the third quarter. And Abby, who is still with us here, what do you think here? I mean, it does seem like even the attempts that China has made at stimulus have not been seen as terribly helpful or encouraging. How much of an issue is that for the U.S. as well?
Look, I think just starting with China policy, like they're kind of stuck between a rock and a hard place, right? They don't want to really stimulate the way that they have in the past as it relates to real estate, right? Because that was a bubble. And that was the true engine, or at least from like when you think about it from a beta perspective, that was what got growth going, right? They want to shift to more consumption-oriented growth, but that's not as much of a hit as you get when you invest in real estate and you have infrastructure investment. So they're really struggling between, okay, do we stimulate on that side where you get a bigger boost to growth, which would show in things like exports and imports, or do we really focus on the consumer? And our view has always been that it would be more of a consumption-oriented stimulus. We haven't really gotten that. And I think, that's I would say China remains probably our least favored international region because it's like you're waiting for a stimulus to happen that might never happen, right? You're waiting on a government to make a decision that you don't necessarily have any clue whether or not the probability is high or low. What I would say in terms of the US though is it's, we've heard from a number of different, over the course of the earnings season, a number of different companies operating in different segments within that economy. And that's what matters, right? It's gonna matter what happens with supply chain issues, right? Like thinking about what companies have better supply chain, that have had those supply chains cleared and they have better inventory balances. I think that's what we're focused on. So instead of thinking of it from the whole US market, because obviously a lot of these companies do get their revenues from China, it's focusing on areas of the market that have have seen their supply chains clear up.
Yeah, and I think back to one of the FactSet stats that came out prior to last week's earnings, and of course we got some huge U.S. companies that do have China international exposure as well, but S&P 500 companies with more international exposure had already seen an earnings decline of negative 21%. Coming into last week. That was ahead of Apple, ahead of Amazon, and of course a host of other household names. All that considered, how does pricing, how does the competitive landscape change drastically for those companies that are still trying to make sure that they have inroads or they have a positive customer sentiment even within those regions? Yeah,
I mean, I think, what's interesting is I think there was a headline yesterday or last week talking about how companies have kind of retraced from being over there, right? And you think about all of the stimulus that's happening in the US that's focusing on building out those capabilities here, right? We have $2.5 trillion of fiscal spending that's going towards infrastructure, that's going towards reshoring. All of those things are happening for a reason. It's because of the supply chain issues that we had over the past couple of years and the fact that we want to avoid that. Geopolitics obviously plays a part in that. And so I think companies are really going to probably start to focus more on the fact that there is all of this, not only public spend, but also private spend that's geared to the US as well.
Right. Abby, thanks so much for coming in. Nice to have you on. Abby Yoder is JP Morgan Private Bank U.S. Equity Strategist. Appreciate it. We got much more coming up, including the opening bell and some movers for you. You're watching Yahoo Finance.
What's the story that we're not talking enough about this year?
I think it's moderating inflation and the impact that's going to have on pricing. We're starting to hear companies talk about that, but I don't think investors totally understand the impact on earnings for next year.
Let's talk about some movers ahead of the opening bell here. Beyond Meat shares are down by 18% after the company saw lower demand for its plant-based burgers and sausages. Revenue fell by over 30% in the last year, and the company now expects revenue of between $360 and $380 million for this year. Matt Miller, Tabak Managing Director and Equity Strategist, is still here with us. The company also says it's not going to be cash flow positive in the second half of the year like it predicted before, Matt. What do you even do with this thing?
Well, the big concern is my take is a little bit different here. Is that the biggest concern is that the issue you just talked about it was the demand is down. Yeah, that's a problem. But they're talking about cash burn. I mean, they're going through cash now. They're not getting cash flow positive, and so what do? They have to turn and go back and raise more money. The problem is now people kind of forget the real reason that Silicon Valley Bank went under was that because there was a run on their bank. Why was there a run on their bank? Because all these startup companies weren't getting any new money from the private equity and venture capital people anymore. After the Fed has tightened tightened lending. Has tightened the overall policy. Liquidity is much less plentiful, and there's less money for these people to give out. I mean, I'm not saying that the Beyond Meat's going to run out of money and they're going to go out of business or anything like that. But they need to get cash flow positive. I mean, they need if they're going through cash at a fast rate, that's something that is going to be a big concern for investors. So I guess my point is, I'm not surprised that we've seen some big declines of 6, 7, 8% in certain stocks. This one's down a lot more because of this issue that. I think people kind of forget about what happened with that banking crisis just a few months ago.
Matt, when we think about normalization for a company like Beyond Meat, post COVID, everybody rushing to the freezer aisle to try and get some of the alternatives perhaps put into their fridge, and that spurring some of the growth for the company and that different retail side of the business. And then even prior to the pandemic, you had the restaurant side of the business and all of these flashy partnerships that Beyond Meat was able to see some new deals come about through, or at least tests or pilots with their Beyond Meat patties and sausages and so forth. So post-pandemic now, what does normalization look like for this company?
That's the big question, because we just don't know where was that demand. Was this one of the things that was kind of a fad that people got excited about because they were they want to do things, they want to eat less meat. There's all sorts of environmental issues involved with that. But with inflation getting higher, people are like I want to do what I can, but I've got to I still have put food on the table for my family. I mean, let's face it, we still have 60% of Americans living paycheck to paycheck, and they're becoming much more concerned about how much they're spending on everyday expenses. Does that turn this thing into a situation where people are like, geez, I'd love to do that, but I just can't afford to. So I'm going to move away from these things like Beyond Meat and other non-meat substitutes. And again, so you have a situation where you worry that this has just been more of a fad is too strong a word, because people do want to do it, but I just don't see it as something that is sustainable in a time when the economy isn't doing as well as people would like. Again, avoiding recession is one thing, but big economic growth is not what we have on our horizon.
And just quickly, Matt, is this something that you would recommend people buy?
I would stay away from it for right now. I'm not worried about them surviving, but with companies that are burning through cash right now in a situation where private equity firms and venture capital firms have less money to give out, this is going to put a strain on their business. And I just think that there's other places that you can buy the dip and have a lot better opportunities.
Matt, stick around because we got the opening bell coming up in a few seconds here. And it looks like that we are setting up for a bit of a lower open here this morning. As we were talking about earlier, we had that Moody's downgrade of bank stocks, even though it wasn't necessarily, didn't tell us anything that we didn't already know necessarily. Ditto goes for the data out of China, but a little bit more of a negative tenor has crept back into the market to some degree. I'm looking across assets too, seeing things like crude oil down by more than 1% this morning. That is catching my eye as well. And in terms of what we're seeing in the bond market, which has been obviously very important, and stocks have been taking their cue from that, we're actually seeing a decrease in yields across the curve. So that's interesting because it is not helping stocks here this morning. Well, we just had the opening bell on Wall Street, so let's indeed take a look at the opening prices here. And we have that pullback that we were talking about. The Dow off by 0.5%. The S&P also down by about 0.5% here today. I think the Nasdaq Composite looks like it is still working on opening up, it being a large, oh no, it is open. It's down about 0.8%. So, Mr. Smith, what are we seeing over here?
Hey, yeah, just taking a look at let's pop together these charts. Let's get some lines or maybe some candlesticks going. Either way, take a look at it over the past 2 days. We're still higher by about 0.5% on the Dow. Out of the gate this morning, we are down by about 0.6%, as you mentioned there a moment ago. And just to kind of round up the major averages, the Nasdaq Composite down 0.8%, S&P 500 past 2 days still net positive, but here today down 0.6%. Let's take a look at some of those sectors for the S&P 500 to see where things are faring out of the gate here. 11 S&P 500 sectors. We've got them loaded up here for you on the screen, and only one bright spot right now. That's XLV. Yeah, taking a look at that 0.5% move higher in healthcare. And everywhere else is red. XLB is bringing up the caboose. Right now, that's down by about 1.8%. Let's take a look at the tech stocks here. Some mega cap tech activity for you here out the gate. We're down by about 0.9% on the MSFT, Microsoft shares. Alphabet, Google, Alpha Google, whatever you call them down this morning. Amazon also lower by about 1%. Apple here, one of those mega cap or the Magnificent Seven lone gainers here on the day, at least at first glance as of right now. But taking a look at Apple shares, they're up by about 0.2% here. We'll put this on an equal so you can just see how much red there is. As of right now, Datadog, look at that, bringing up the caboose in the Nasdaq 100. That's down by about 19%. However, leading the charge, Amgen, it's up by about 1.8%. Really, that high-pitch note brought to you by my stretch to try and get across the screen there, even though the stock chart didn't come out.
You know, speaking of Amgen, if we have, I believe we have a pharma or drug maker chart that is on one of the heat maps there, because as you noted, healthcare is the best performing group within those PBMs, but I think we have. We have drug maker strip. In any case, healthcare, the best performing group in today's session. Amgen is part of that. Eli Lilly is part of that, which we're going to talk about later. And some blockbuster data out of Novo Nordisk regarding its diabetes drug, helping cut the risk of heart events, heart issues. So we're going to talk about that later on as well. I guess there is no drug heat map. All right, we got to talk to Mr. Blickery about that.
We're going to make that one for you.
All right, sorry, Brad, to make you chase it. All right, let's turn to another stock we're watching. That is Palantir. The shares are now down 7%. What the heck's going on with this one? When I came in this morning, the shares were higher by about 1/3%. They have been vacillating all over the place after their results last night. The company did beat the street's revenue expectations. They did raise their annual revenue forecast. Palantir banking on growing demand for its artificial intelligence platform. Analysts, though, do seem somewhat mixed here on the prospects for the company. You're looking there at some of the different ratings that we are hearing from, but according to Dan Ives of Wedbush Securities, who's been bullish on the stock, Palantir is the best pure play AI name. Morgan Stanley's Keith Weiss views Palantir as attractive. He put an $8 price target on the stock after the company's earnings release here, but there still are plenty of bears. The street currently has 8 sells on the stock. So more sells on an absolute basis than either holds or buys. So that perhaps helps explain that there is still not terribly bullish sentiment here. Let's get Matt Maley's take here. He's still with us, Miller Tabak Managing Director and Equity Strategist. So what's your view on Palantir here?
Well, it's, the stock has had an unbelievable run. And so it almost seems like the initial reaction was a positive one. It almost seems like we had this buy the rumor, sell the news reaction today. And we do, some of their commercial enterprises, they want to see those. I think a lot of people on the street are hoping that they'll do better. They've got a great business with the government, and that some people are saying that's could be create some headwinds at some point that might slow. I don't see that at all. I think their contracts and their relationship with the U.S. government is a strong one, and that's why I love the stock on a longer term basis. Near term, though, we're also starting to see is that this whole thing with AI, nobody's saying, oh my goodness, AI is washed up by any stretch of the imagination. But it didn't have the same kind of impact it's had this whole entire earnings season as it did 3 months ago during the last earnings season, where all these stocks just skyrocket to the moon. This time around, we've had some that have done extremely well, but others like Microsoft and Apple, Advanced Micro Devices, et cetera, that haven't done as well. So I just think it's kind of people kind of calming down a little bit more about the AI, the froth around AI, and maybe needs to calm down a little bit more. And that's something I think that's going to be cause some serious problems for the company.
Matt, I'm taking a look at their revenue raise. They raised their revenue guidance in excess of $2.212 billion. For a company like Palantir, what does that signal to you, especially given the different divisions that a company like this operates in, their government revenue side, but then additionally in just their larger kind of corporate customer base as well that they go after?
Yeah, this corporate customer, the commercial side of things is where they're going to have their big upside. And again, I'm not trying to say that the government side is not a good side. In fact, that's really important, and it provides an unbelievably strong base for the company. So if they can, expand more into that commercial side, it's going to be something that's going to help the company on a long-term basis. So again, we always want to look about, for the longer term. And we talked earlier about the Beyond Meat. Is that a good one to buy on weakness? I don't necessarily think that's the case, but Palantir is definitely one that I think on especially any kind of sizable dip, is one that people should be looking at.
Matt, the CEO of Palantir, CEO Alex Karp, told Bloomberg, "We have a good chance of becoming the most important software company in the world." When you hear a statement like that, does that give you a lot of, does that say to you, wow, he's being ambitious, good for him? Or does it say to you, this guy needs to get real?
Well, I mean, you always worry that when people are getting, are they getting too overconfident and such? He's a very impressive guy, very smart guy. But I like it personally. I just think that, again, when you have somebody who's working with government contracts that provide a really nice, strong base for the company, that gives you all sorts of upside potential. When everybody talk about what's the downside, so much right now, people always look at what's the upside to everything? What's the upside to everything? Well, we also want to see what's the downside. And sometimes the downside can be very, very big. With this company, with the huge amount of government contracts that they have and the strong relationship they have with the government, that provides the kind of base that they can achieve some of the goals that they're looking for that not everybody else has.
Does Palantir ever run the risk of doing business with the wrong governments?
Well, that's of course that's always a big question. But I think when they're concentrating here with the U.S. government, if they wouldn't be, their management, the entire management team is a strong management team. I think they're going to be smart enough to stick to their knitting in terms of what they do domestically. And if they look like they're veering too far off course, I think people will push them back to the middle, and they will heed those warnings or that advice. But again, yes, that's always an issue you got to worry about, and obviously we don't want to monitor that over time. But I don't see it as a big issue right now.
Certainly, just worth a question perhaps of external deal scrutiny that we discuss all the time versus internal deal scrutiny. Matt, thanks so much for taking the questions and taking the time here this morning.
Thank you. Have a great one.
Great to see you. All right, guys, switching gears here. Let's talk a little Chegg. Chegg shares soaring today. They're up 19%. That's as the online learning platform argues that ChatGPT won't be as detrimental to his business as initially feared. Our own Josh Schaefer is here to explain what's changed for Chegg after a rough run since ChatGPT's launch. Josh, what happened on the earnings call?
Yeah, Brad, so it's an interesting story. You really got to kind of go back to last quarter's earnings to understand this quarter's earnings story when we think about the fact that this stock fell nearly 50% on earnings last time. So they came out for the first time and said, ChatGPT is hurting our growth rate, hurting the amount of people that are coming to Chegg because students use Chegg to learn more and help them learn online, right? So then they came out yesterday, and in this earnings call, it's really interesting to hear what CEO Dan Rosenzweig had to say about ChatGPT. He said that students are now viewing ChatGPT and will continue to view ChatGPT as complementary, but not a replacement for Chegg. And I did a little bit of market research first this morning to see what he's talking about, right? So I asked Chegg a question, or asked ChatGPT a question about Chegg stock. But what ChatGPT can't do is it can't answer a question beyond September 2021, the basic version of ChatGPT. So he's sort of arguing in the long run, you need Chegg because you need updated information, or you at least need an advanced version of ChatGPT, which I thought was interesting.
I mean, they're probably going to update it at some point.
No, they will. They will. But for now, right now, it's not a pure competitor, which I thought was a fair point. And then he also talked about those retention rates, and the retention rates have become more steady through the last couple months because retention rates were falling because of ChatGPT. They've seen that increase over the last few months, still down compared to before, compared to last year, but a lot of that they're also attributing to the pandemic, right? I remember a lot of people started using Chegg over the COVID-19 pandemic with students at home, so they're still sort of dealing with tough comps there anyway. And then the other downside thing that we should highlight, even though the stock is up 20%, you still have revenue down 6%. And I thought it was interesting. Our friend Brent Thill over at Jefferies pointed out that, the AI overhang isn't gone off the stock. It's just the stock has been beaten down so much. This was a $30 stock when ChatGPT was launched. It currently sells at $12. It was a over $100 stock at the peak of the pandemic. So I think what investors are probably seeing right now is if you can see a turnaround story in this name, then maybe there's some promise, right? Because the stock has been beaten down quite a bit. Brad, I see a little grin on your face.
Skepticism.
Skepticism?
I mean, it is still down more than 50% year to date, to your point.
Yeah.
So it's not, is there a happy medium between ChatGPT is going to put Chegg out of business and Chegg is going to continue and do what it's doing? Yes, probably there's some sort of middle ground there. Like is everybody just going to write papers with ChatGPT going forward? They're not going to need books anymore, and they're not going to need aids to learning? No, that seems unlikely.
Yeah, no, I think there's so much. There's an assistance that generative AI can provide certain students in terms of being able to not just cheat, but make sure that they have an access to an additional amount or an augmented or additive amount of information, I should say, versus what is solely in a textbook, what is solely in a Chegg learning model, or what is essentially tapped into via those services. So yeah, they can coexist, but it's at what usership as well. Do you see a drop-off in those number of users that are either purchasing through some of the services or solutions in Chegg, and how much does that actually take a part of the valuation, a chunk of the valuation? We see that in the stock already.
Right, and the other thing that I was really stuck on last quarter was Chegg's solution here was to partner with OpenAI and essentially say, we don't have the infrastructure to use this. We're going to use the competitor's infrastructure to help us compete with the competitor, which from an investor perspective is never usually that good of a sign, right? That might be a sign that Chegg doesn't have enough going on with their current business. But it was interesting, so they actually have a new partnership now with Scale AI, which is not OpenAI and is not ChatGPT, and that's their generative AI play. So they're going to use Scale AI to build out generative AI with their own data, and they're arguing that ChatGPT and that partnership still exists, but that's going to be called Cheggmate, and that's just for conversations. And so they'll have a different generative AI play.
We do this name? This is a fun one, though.
Do we know it already?
Cheggmate.
Yes, Cheggmate's been out.
I guess I
Cheggmate's
forgot, but I still like it. All right, thanks, Josh. Appreciate it. Well, we are also watching shares of Tilray this morning. The company announced an acquisition of 8 AB InBev brands. They include Shock Top, Red Hook Brewery, and Highball Energy. That deal is projected to triple the size of Tilray's beer portfolio. The company expects output to increase from 4 million to 12 million cases annually. And this sort of continues in the company's roll-up strategy. I mean, this is something we have seen Irwin Simon, the CEO, do before. He did it at Hain Celestial, where he rolled up a bunch of different natural brands. Now he seems to be building this sort of consumer products brand that initially was centered around cannabis, but now we're seeing more forays into alcohol.
I think it's a good strategic move here. I mean, we think about our own internal executive editor, Brian Sazi, who has a Highball Energy on his desk just about every day. And there's a strong customer base out there that wants to make sure that they get that jolt in the morning. Outside of that, you've got the other end of the market, those that are looking to chill out a little bit later on in the day through one of the other, the Reds? Anyway, I know you mentioned it a moment ago. the name is escaping me. But now that we think about how they're going to kind of set their own positioning through these beverages over the course of the day to say, okay, we can be in your energized or ramp up part of the day, or we could be in your kind of come down or your relaxation part of the day. I think it's a good strategic play. I think the company already has brand equity in the name alone. When people find out that it's all pulled into the same brand, there is still going to be the lingering question of, okay, so how far away are they from making sure that there's potentially some cannabis infusion of all of these different drinks?
I believe they're in that business as well. But I guess the other question is, cannabis has proven to be a very volatile business. Yeah. So does this help them smooth that out more and provide a more steady source of revenue on the beer side, perhaps? I guess we'll find out.
Yeah, all right. Well, Tilray into the bodega beverages now. Fun stuff, guys. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
VIX shifting higher today, and what does that signal for investors? Yahoo Finance's Jared Blickery on the floor of the New York Stock Exchange. He's got the details. Hey, Jared.
Hey, let's get wonky with some options talk here. That's because the VIX is derived from S&P 500 options, and I'm looking at the VIX on the Wi-Fi Interactive here. This is going to be a 3-month chart, and you can see over the last few sessions here, we've picked up, but not a lot. You can see we haven't even come close to hitting that 20 plus level that we hit in May. And if we take a look at the year to date, farther away still from those heady levels, those lofty levels above 30 that we saw around the internet banking panic. So nothing too concerning yet, but we are approaching that time of year when the VIX does pick up. So here's a picture of the S&P 500 year to date. Just want to show, this is going to be important in a minute or so. We have weakened, we started weakening about 10 sessions ago, 8 to 10 sessions, and that's an important time frame that I'm going to use to track some of the sector action. First, I just want to show that VIX seasonality chart that I was talking about. We can plot the average VIX movement, and it's this white line here. You can see it peaks in February, March, it declines into July, it spikes into September, October, and then it declines again into the end of the year. That's when you get that Santa Claus rally. Right now, we are right here. So we are right at the beginning of that next potential up leg in the VIX, which usually means downward prices for equities, and this persists into September, October. That is prime crash time for the S&P 500, just because historically we've had a lot of crashes. Now, you compare that with the average returns in that period, it's a different story. The crashes don't outweigh the benefits of holding through September, October, so it's actually a pretty good couple of months to hold stocks through, but caution is warranted. Now, I mentioned before the 10-day time frame. I just want to show what's happened in the sectors since we hit that peak. Communication service is the only one in the green. That's a Meta and Alphabet story. At the bottom, we have utilities, tech, real estate, and materials, all in dark red. Utilities, very interest rate sensitive. So is tech and real estate for that matter. And materials, that is a soft or strengthening dollar story. When we take a look at some of our leaders here, we're only seeing green in what? Cannabis, that's its own animal, defense stocks, regional banks barely positive, home builders barely positive. But we've seen a lot of the fringier sections of the market sell off. And that is very evident when we take a look at meme stocks here. And we can see a number of names, not the least of which is GameStop. GameStop down almost 11% over the last 10 days. These are stocks that had been spiking over the last month or 2 months, kind of late to the party, you might argue. But in that sense, the fact that they're coming down right now, probably a return to normalcy, because a lot of these guys got a little bit carried away in terms of their multiples. The bottom line is we are heading into a seasonally volatile period of the markets here. We are coming from overbought levels, so we are a little bit too strong and we need to work some of that off. And that's what we're seeing right now. It's still summer, and it's going to be that way for another few weeks, guys.
Thank goodness, if only it were longer.
Yes.
Thanks so much, Jared. Well, as retailers gear up for the second half of the year, our next guest is laying out a roadmap for sector outperformance in 2024 with 7 catalysts she says would give the all-clear signal for sector recovery, although not all of them are positive catalysts. For more on all of this, Adrian Yee is joining us now, Barclays Consumer Discretionary Analyst. Adrian, it's good to see you as always. When you look at these 7 catalysts, which to you is the most important?
The most important is we have 4 company-specific ones, and the most important was last year it was inventory. But the fact of the matter is everybody's cleaning up inventory. So now the most important thing is to see sort of that second derivative of demand. So any notion that over the next 6 to 9 month horizon, that demand becomes more forecastable. And with the Fed thematically pausing or slowing down their rate hikes, that certainly helps. With inflation coming down, that certainly helps. So the most important thing for us is looking at future demand and the ability to forecast that along with de-risked earnings and sales, right? So a lot of these companies, right, are coming out. We're in the early phase of our wholesalers. We'll go into retailers. If they can hold on to the guide and basically, do the back half and get to those earnings and op margins with freight and promo recovery and below the top line, and then have top line on tight inventory, that's what the call is about for 2024.
Which companies are best positioned to be kind of immediate beneficiaries in that instance then?
So the immediate beneficiaries, and mind you, right, sales are still coming down as we speak right now. So the Fed's 11 hikes in 17 months are doing their work right now. So as we sit here right now, sales don't look so great, and you're seeing people guide, particularly in wholesale, right? They're guiding slightly worse than expected. DTC, retail's as expected. But the names the beta play names, they're going to be your retailers, your frontline retailers, American Eagle, Urban Outfitters, Gap, Tapestry, Lululemon, right? It's going to be your frontline retailers who are exposed to you and I as the end consumer.
Since you mentioned Gap, I have to ask you about the new Gap CEO, Richard Dixon, and whether you think that he's going to be able to, rescue, maybe for lack of a better word, that brand.
So the brand being Gap, right? And then there's Old Navy. And Old Navy has a place, right? So I think when we think about GPS, because the namesake is Gap, I think Gap's a much more difficult animal to turn, right? We've got new leadership at Athleta from Alo Yoga. I think that's going to be, they lack innovation, but I think they're in a great sweet spot there. And then for Old Navy, I think it's just getting back to the fun and the innovation and some of the kind of kitschiness of Old Navy, which I think they've really lost their way there. So to the extent that he comes from Mattel and has sort of a background in consumerism and making things fun, you saw them kind of have a Gap X Barbie launch. They've got Love Shack Fancy. So they're starting to do some things that I think are very interesting and are much more consumer focused. So we're very hopeful. We upgraded them last week as well.
I'm also curious, in concert with this sector upgrade, you also, as always, are watching promos very carefully. And we have what struck me, you looked at a sort of a longer term chart of sales of promos from retailers going back like 10 years. And the trend has never been better. Like it never improves above a certain line, which really struck me here. But are retailers doing better at managing our expectations when it comes to promoing and their margins as a result?
So the source of promotions, as you know, I like to talk about this, is inventory. And it's inventory, more importantly, inventory growth relative to sales growth. So we always like sales growth going faster than inventory. Inventory is very, very tight right now, but it's unfortunate that sales demand is so sluggish that they need to take this lower, units of inventory, this clean inventory, and they're trying to promote to drive traffic and conversion to get you in the door. So, as we get through sort of the excesses of wholesale in the back half of the year, because normally retail and wholesale inventory are coincident when they're clean. This time, because we stuffed the channel, right? Globally stuffed the channel, the wholesalers are depleting that inventory in stock while the frontline guys are very clean. At the end of the year, everybody's going to be clean, heading into 2024 with a better forecastable demand outlook. And that's where we think it all comes together.
Stay with us, Adrian, because on the topic of promos here, I just want to bring our viewers up to speed on Under Armour earnings. Under Armour earnings came out this morning here, and particularly on the revenue side, revenue was down 2% to $1.3 billion. We're watching shares right now. They're higher by about 0.7%. But as you were talking about promotions just a moment ago, Adrian, their gross margin declined 60 basis points, and they pointed towards higher promotions and adverse effects from changes in foreign currency, partially offset by some supply chain benefits. All that considered here, I want to get your read in on Under Armour from this quarter.
So this quarter was largely as expected. The inventory is coming down. And again, they are, majority, right? So call it 58% or so wholesale. So what was interesting is their DTC business was actually up 5%. And that's kind of where they actually had promos. So they're kind of trying to clear through. And this is not Under Armour specific in their DTC. It's just a promotional environment, as I was mentioning before. One of the interesting things is they did reiterate the full year guide. And they are lowering North America, particularly in the wholesale. As we move through wholesale, right, the retailers are being ultra conservative. As we go into the back half of the year. But as we come into next year, right, it's very hard for retailers to buy down units again, right? Because if you buy down units, you get down sales. And so we think as we go into calendar, 2024, March quarter, June quarter, this is just kind of the cycle of wholesale, depleting that in stock, and then you'll start to see the kind of renewal or the replenishment. So Under Armour largely as expected. I think it's kind of, nothing to call out here, nothing alarming. Clearly, they did guide down their wholesale a little bit worse than expected, but the DTC should pick that up for them.
Adrian, really invaluable to have your insight here, especially a few weeks before we start to get into these specialty apparel and retail earnings in earnest, and you're going to get busy. Adrian Yee, Barclays Consumer Discretionary Analyst, thank you so much.
Thanks for having me.
Well, China's also on our radar today after exports plunged in July, but here's why U.S. investors should care. A new report from J.P. Morgan shows that despite a rise in U.S.-listed China stocks, the value of these companies is falling as the Chinese government cracks down on further restrictions. Stay tuned for our interview with one of the people behind the report, J.P. Morgan's Gabriela Santos. That's not her. That's Ken Rogoff, who we're also going to talk to.
Yeah, we're going to speak with Harvard's Ken Rogoff. Make sure to hear on everything from China to U.S. debt stability. Stay tuned for that interview. That's in the next hour. All your markets action straight ahead. When you think about the bellwethers that we've seen over the course of this earnings season, is there one that kind of takes the cake?
I think that in large cap tech, things have been fairly mixed. There's been some good and there's been some bad. The growth trade is fighting back, trying to keep leadership, but the value trade is putting up a pretty valiant effort to take it over, and the growth stocks haven't made it easy.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Julie Hyman, and we're a little more than 30 minutes into the trading day, so let's take a look at how stocks are moving. We are seeing the major averages in the red. That's due in part to the downgrade that we saw from Moody's for a slew of regional banks. Several big lenders also now on downgrade watch. The banking sector has been combating higher deposit and borrowing costs thanks to rising interest rates. So we are seeing the major averages under some pressure, although it is tech that is feeling the most pressure today. Shares of Novavax jumping this morning after the vaccine maker reported a surprise second quarter profit from its new COVID-19 vaccine. CEO John Jacobs tempering expectations for the near future, though, noting there would be little to no sales of the shot in the next quarter. Novavax can only start rolling out vaccines once the FDA makes a decision on the new shot. That's expected to come in late September. Hims and Hers shares also on the up today after surging revenue led to narrowed losses in the second quarter. The company saw its subscribers jump from 748,000 to 1.3 million and also raised its full-year revenue guidance as it announced the launch of its weight loss management business. That's to come by the end of this year. And we are also watching Olaplex shares here. Those shares down by 17.5% after the company cut its full-year guidance amid slumping demand. Its professional channel sales plunged over 60% in the second quarter, and specialty retail sales fell by over 53%. Now let's send it over to Yahoo Finance's head of news, Miles Udland, for a look at the new Yahoo Finance chart book. Very exciting.
Thanks, Julie. Well, for investors, 2023 has been a year of exceeding expectations. The stock market has rallied, the economy continues to grow, inflation is cooling faster than expected. So in our first Yahoo Finance chart book, each of these themes makes an appearance. But there's also a sense of uneasiness coursing through the 50 charts featured in this collection. Is the consumer softening? Will the Fed finally derail this rally? And is corporate America sending us a subtle warning that hasn't yet hit the mainstream? Joining us now to discuss our three contributors to our chart book. Steve Sosnick is the chief strategist at Interactive Brokers. Christine Short, VP of Research at Wall Street Horizon. And Jay Woods is the chief strategist at Freedom Capital Markets. Thanks to all of you for stopping by today to talk about this. So, Steve, let's start with your chart, and we'll put it up here on the screen. Basically looking at the relationship, or surprising relationship maybe perhaps, between the Fed and the stock market. And maybe you could just walk us through kind of what you're seeing here and what maybe your takeaways are.
Yeah, well, thanks, Miles. When we look at the chart, we see that the expected pattern of the Fed balance sheet, you know, it peaked about a year and a half ago, and it's been coming down since because of quantitative tightening. But remember, the Fed always talks about long and variable lags. But I think that really is an asymmetric situation. The long and variable lags are when they're taking out liquidity, which is why there was a sort of a, I'm not going to say a gentle path in 2022, but it was sort of a delayed reaction. Mm-hmm. On the other hand, you look at the spike in that chart on the bottom, in the sort of on the top line. Yep. That's the light blue line is the securities held on the balance sheet. That's QT and QE. The pop there was the Fed putting $300 billion onto their balance sheet to provide liquidities to troubled banks. That once the banking crisis was gone, the market picked up on that immediately. Maybe not vocally, maybe not obviously, and you'll see the S&P 500 ticked up immediately after that. The ramifications now are, you could see the lines back to where it was before the pump, yep. And so now we're on our own.
And I guess my question in thinking about this dynamic between QT and the S&P, and it really goes to the question for all stocks all the time, is, you know, is there a question about the second derivative, meaning since we all know that QT is going to go at a certain type of pace, the S&P has made its peace with it and is sort of looking through that to an extent, or is there maybe something else, you know, lurking within this as we revert perhaps even to kind of pre-COVID levels of the balance sheet?
I think the market's made some peace with it, but you remember, you know, rule number one that I was always taught was don't fight the Fed, and to some extent, you know, we fought the Fed a little bit of late 2021. We succumbed to the Fed in 2022, and we were helped out by the Fed in the, you know, call it in the March-April period after the banking crisis was resolved. Problem now is I think we're back to fighting the Fed, and that becomes a trickier situation right now.
And of course, in the month of August, never really friendly for the stock market, and seeing that over the last couple of days. Christine, I want to talk about your chart, which was one of the more interesting ones that we kind of had in the pack, because it was not really something that I had thought about before, like in a quantitative way. Qualitatively, you kind of think like if a company changes anything, it must be bad. But walk us through a little bit of what this chart is showing us about the timing of when companies announce their earnings.
Yep, so this is a proprietary metric we calculate at Wall Street Horizon called the Late Earnings Report Index. Basically tracks outlier earnings dates for publicly traded companies with market caps over 250 million. So like you said, a company many of these we've tracked for almost 20 years. So we know, for instance, Intel likes to report report the Q2 earnings the Thursday in the 30th week of the year. And some companies really stick to a specific week, a specific day of the week. And so we, get a signal when they're reporting way outside of that range. And there's academic research that shows if a company significantly delays their earnings report, well, tends to be that there's bad news that, follows in the report, and then the stock goes along with that. And vice versa is true. If a company advances their earnings, they're probably out there reporting better than expected news. And so we aggregate this on a company level. And as you can see for Q3, this Q3 is referring to companies reporting for the Q2 season. That metric has ticked up a little bit. And the closer it gets to 100, the more worried we get. The 100 is the benchmark. Anything above 100 means more companies are delaying earnings. Below means companies are a little less uncertain. So we're at 95. It's been trending upwards, and it's at the second highest level it's been since the pandemic. So like you said in your intro, do corporations see something the rest of the marketplace isn't looking at? What are they feeling uneasy about in the second half of the year? And some of these things, yes, inflation's easing, but if you look on a sector level, a lot of the consumer discretionary companies seem to be delaying, which would make sense as consumers soften a bit.
And I guess maybe another thought around the delay here for companies is that the process of reporting earnings basically begins the day after you report the prior quarter. And so even moving that by a day is a pretty significant lift for the IR team. It's a significant lift for your corporate executives. And I guess as you think about it, I don't know if you guys have a thought around this, but is it more the numbers, or is it like the story you want to tell that forces you to push back? I mean, take this quarter for an example. Yeah. Well, guys, we don't have an AI strategy yet. Like, let's take a week, and then maybe we can get generative AI into the release a few more times. The stock goes up. How do you guys think about that?
Yeah, I mean, all of the research shows, look, there can be a bunch of different reasons. It could just be a scheduling conflict. It could be a new CFO. So I'm always kind of looking when a company significantly delays or something. I see, did they hire a new CFO? And a lot of times it's like, okay, there's been changes to management, and now that person wants to push it a week forward. Sometimes they just forget to publish it. We've had that. Our analysts will email the IR team, and they're like, are you reporting next Thursday? And they're like, oh, yes, we are. Whoops. And like they send out the press release. But you're right. A lot of times it's if they're delaying, it's like, oh, is there going to be some accounting manipulation they need to do? They got to fix the books a little bit here. Are they messaging? Are they trying to figure out how to bring this out to the marketplace so that investors don't freak out? So they're massaging the messaging a little bit. Are they trying to hide it? They're reporting in a different week, maybe a busier week. And so those are all possibilities. I wouldn't, this doesn't work 100% of the time, but I would say 2/3 of the time we find it really does go directionally one way or the other. And one great example from this morning, UPS. A few weeks ago, we reported that they confirmed an earnings date 2 weeks later than usual, the latest ever since they IPO'd. And look at what happened today. And we knew there was some turmoil in there, right, with the unions and the potential strike, which they seem to have skirted. But they reported today they missed revenues and they cut full year forecast. And so that's one that went in line with what expectations would have been.
Yeah, and then I guess we can, next time we'll talk about whether you're a pre-market reporter or after-market reporter and how that plays out.
A lot of studies on that as well, yes.
Yeah, I'm sure. So Jay, I want to talk a little bit about what you showed in your chart. And really, you kind of see it again today in the market where you have a big risk event and what's reacting most. Well, the tech sector is reacting most, but you look at what happened with the Dow last year, major outperformer, and it's been an interesting place this year, looking at the cyclical thought around the economy right now. We're looking at Dow with Dow Transports. Talk us through a little bit about what you're seeing in this chart for the health of the market overall.
Yeah, this is old school technical analysis 101 Dow theory. This is a theory that goes back to the early 1900s. And it basically says one thing. When the Dow Jones Industrials, the things that make, and the Dow Jones Transports, the things that take, are doing well, and in this case, both at 52-week highs. Yes, we're pulling back today. Yes, we're hitting seasonal headwinds. But they're at 52-week highs, and they're within 5%, 4% roughly, of all-time highs. This is a bullish development, and it's something we have to watch. The first half of the year was all about tech, and it was all about the Magnificent Seven leading the way. Now we're seeing a healthy rotation. The industrials broke out. The transports are doing well. We focus too much on the airlines, but these are price-weighted indexes. The airlines aren't really a big weighting. What you're looking at is Old Dominion. You're looking at some of the railroads that are doing well. You're looking at Avis Rental Car, symbol CAR, that have been doing well and leading us higher. Yes, UPS is taking us a little lower today, but FedEx has been doing extremely well. This is what I want to see, and this tells me that the economy is clicking. It's not just the tech sector, but it's the industrials, it's the transports, and now they can pull back. This is a healthy correction, but I think the uptrend is intact. We're over 20% off the highs, and you have to pay attention to old Dow theory. It proves time and time again we're in a bull market.
Now, I'm curious how you think about the Dow. I mean, you kind of walked through like the history around it, but the question is always, well, there's not a ton of money benchmarked to the Dow relative to the S&P, but it's certainly something that traders and money managers look at for the signal it sends to the market. So how do you think about the Dow and the transports in that context where it's something people watch? It's not something that there's trillions of dollars bet against, but it still kind of factors into that question for the market.
Yeah, and that's a great question. And historically, if you were to put up the Dow and the S&P 500, I'm perplexed by this, but they trend the exact same way. We're talking 500 stocks versus 30. The index just has a way of rotating, and we're seeing that again and again. Healthcare starting to come back. Amgen looks great. United Healthcare, the biggest weighting in the Dow, is starting to make a move. If that breaks out and continues to rise above its 200-day moving average, the Dow's going to go higher. Boeing just broke out, one of the bigger industrials in that average. This is good. When Walgreens Boots Alliance doesn't do well, it's a $30 stock. Intel, $30 stock. Who cares? You have to look under the hood, look at the leadership, and it's the same thing with the transports. I mentioned the airlines are weak. You want to watch some of the rails that are doing well, some of the shippers, and talking with shippers. Kirby and Matson. No one even knows these stocks. But these stocks are making 52-week highs. Kirby based out of Houston and Matson, a Honolulu, Hawaii company, making 52-week highs, a $95 number. These are the things that are going to lead, and these do shape the economy, but people don't talk about it.
And so I guess last one then for you, Jay, just thinking about the market, you mentioned the Magnificent Seven, which kind of led the market this year. How focused were you, and I guess do you remain through the balance of the year on this notion of broadening in the rally? And we saw it June to July, we saw materials, we saw industrials doing a lot of the heavy lifting there to get the market, within shouting distance, really, of a record high. How are you thinking about the breadth of the market at this point in time?
Yeah, I love this. We're seeing weakness in Apple and Microsoft, who had great quarters. What are they doing? It's a natural pullback. The Apple pullback's a little farther than I expected, but we're catching up with the other sectors. So the rotation theme continues. You mentioned materials. They look great. And if healthcare can catch up, then I think we're poised to do well in the Russell. The Russell 2000 had the strongest June and July of any of the indexes, and it continues to broaden out. So to me, this is healthy. When you have the leaders finally taking a pause and everyone else catching up, this is a sign of a healthy market.
There you go. Just don't tell the Russell 2000 about the regional bank comment from Moody's today. Otherwise, it'll be totally fine. All right, Jay, Christine, Steve, thank you guys so much for joining today. Thanks so much for your contributions to the Yahoo Finance chart book. Really fun to see all these thoughts all in one place. And of course, everyone can find that on our website and anywhere you get your Yahoo Finance news. Downloadable PDF as well. All right, all your markets action ahead. Stay tuned. Watching here Yahoo Finance on this Tuesday morning.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is what's next for Samsung.
You can put it in the water.
That's pretty gnarly.
Water.
Innovation is changing our world.
This is the heart and soul of astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series next.
Welcome back. Let's do a check of the market, sponsored by Tasty Trade. We see all three major averages, their declines have accelerated pretty markedly here. The Nasdaq still leading declines, up by 1.4%. The S&P down about 1.1%. The Dow off 1.25% in today's session. I'm unsure what exactly was the catalyst for this latest leg downward. Brad, I don't know if you're seeing anything in the markets here, but it is pretty notable to see this kind of acceleration.
Yeah, I'm just taking a look at some of the sector activity here, and I mean, we started off the day with health being the lone gainer. It's still the case, but market moved lower here in materials, financial, consumer discretionary, technology, all of those leading some of the declines. Materials down the most on a percentage basis by about 2% right now. So continuing to watch some of that sector movement here as the trading activity transpires.
Yeah, and of course we had Moody's downgrade of several small and mid-sized banks, but that was well known before the open. So, we'll keep looking at it. And in addition to that, of course, Fitch downgraded the U.S. credit rating last week to AA+ from AAA, citing debt concerns, volatility, and governance as well. Was this the right call from the agency? We spoke to Mohamed El-Erian, Allianz chief economic advisor. He joined us last week to discuss the downgrade.
What Fitch put in their statement has been true for a while. So why now? And that explains the reaction that I and many others have had, which is, first, this is surprising. Second, when you look at the reason, you scratch your head as to the timing of this. And then thirdly, which is most important for our audience, is the expectation that this will have minimal impact on the things that are sensitive to ratings.
And indeed, even though we did see bond yields rise to some degree in the wake of that, they've come back down a bit. Let's get another view on this downgrade in the U.S. economy more broadly. Joining us is Kenneth Rogoff, Harvard University Chair of International Economics and former chief economist at the International Monetary Fund. Ken, it's great to see you. And it's interesting how Mohamed framed it as, even though some of these issues are around, we've known about them. So it's interesting that it is happening now. It does seem to come down to this sort of political maneuvering that we see in Washington that could hurt the fiscal position of the United States. How urgent do you think an issue that is?
Well, I think the reason Fitch did this was simply to, think ahead maybe 15 or 20 years. If there's some kind of bizarre problem, where were they? Did they say anything about it? On the timing, as Mohamed El-Erian, I think, makes a lot of good points. It's pretty clear Trump's up and up in the polls. The possibility that he might be president has materially risen, and the possibility that there's a very divided president. The president's one party, the House and Senate are another party, in a very fractured system. There's a level of dysfunction. Who can deny this? So they're making a statement. I think the thing that's difficult to sort of reconcile is if the U.S. runs into trouble, so does everybody else. So if you think the U.S. should get downgraded because they're going to spark an international crisis, you kind of have to do that for everyone else. It's not a statement about what they think the interest rate should be necessarily, so much as making sure that they set it. That said, certainly the possibility that we have higher inflation in the future, I don't think is fully factored into markets. I don't know that that's what that downgrade represents. But certainly there's higher chance of that than there was 5 years ago.
And just to kind of add on to that, are there other international economies that you foresee Fitch having to re-rate after this U.S. re-rating?
Well, what I'm really trying to say is if you're going to call the U.S. downgrade the U.S., you're kind of having to change the whole grading system because everybody runs into trouble if the U.S. is. That they're looking at the institutional problems in the U.S. And I think they're undeniable. You have to have your head in the sand not to think that there's an issue. What it will lead to, I don't know. Usually when the U.S. has a problem, it's even worse for everybody else.
Well, it's worse for everybody else, which is sort of how has helped solve the problem for the U.S. up until now. In other words, if it's the least dirty shirt or whatever analogy you want to use that people have used for the United States, that has sort of safeguarded its status reserve currency as safe haven in terms of treasuries. What would change that?
Oh, I mean, I don't know that there's anything going to change that overnight. But I think we have to distinguish between general problems that hit the world, like the pandemic, when the US is a safe haven, and things like the financial crisis in the US, creates some kind of artificial, and it would be completely artificial, debt crisis, which is also a world shock. That doesn't necessarily lead to an appreciation of the dollar the way a pandemic might.
And so even with this downgrade that has rattled markets clearly, is there any more clarity around where the economy actually is sitting with regard to the analogy that we have used for now the better part of a year and change of a soft landing versus a hard landing or any other type of landing that could take place as induced by or as a result of Fed policy?
Well, what I think I've been saying for the last year and a half is we're not going to see a hard landing or a soft landing because there's not going to be a complete landing. I think inflation is going to stay elevated for quite a while. If the Fed wanted to have a landing, it would be a hard landing. But I don't think they want to have that. And so they're going to just be quote unquote patient. So I think those two analogies are missing what's actually happening.
And so are we just in a sort of elevated inflation environment, but also, I guess the silver lining of that is that it's accompanied by some level of growth?
Well, there's no question the economy's been better than anybody thought, and particularly point to labor markets. I think it's less easy to know what's going on with the real economy because the gross national income and the gross domestic product are kind of saying different things. I tend to think the productivity's down quite a bit. The economy's growing in the sense that they're jobs, but not necessarily otherwise. But yes, things are better. If the Fed, it's been remarkable that interest rates have been raised this much. I would say we're in the 90th percentile of outcomes that could have happened here. It definitely could have been, maybe was likely to have been worse, as many people had said. But on the other hand, inflation's not all the way down. And at some point, the Fed has to really look in the mirror and decide how quickly it wants to do it. And of course, the downside of waiting too long is that inflation expectations have remained remarkably stable. I think they have moved up a bit. There's more of a spread in inflation expectations. They're not exactly solid as a rock, but they've stayed stable considering what's happened. And considering what's going on with fiscal policy, the need for defense spending, green transition, et cetera. So far, things have been stable. And I think the trade-off here for the Fed is, can they take a couple more years, maybe even 3 or 4 more years to bring it down to 2%, or is that taking too big a risk?
So what is the kind of larger driving forces around an elevated inflation environment for longer that's still above the Fed target? I mean, is it shelter costs? Is it everybody buying tickets to go see Beyonce and Taylor Swift? From your purview, what are the largest contributors to that?
Well, I think there are a lot of fundamentals that have turned against the economy. So defense spending is clearly going to go up a lot. Look at what happened with the Russian and Chinese ships coming to our near our shores and our not having a big fleet to send up against them. Look at what's going on in Europe and the Taiwan Straits, the green transition. We have not begun to pay for that, much less what needs to be done for developing economies. Populism, whether it's a Republican president or a Democratic president, is going to redistribute income. That's good, but that's going to also lead to greater spending, more price increases. And I think actually the list could go on quite a ways. Deglobalization, no question about it. that the era of peak China has come and gone, and that was also making it easier to keep prices low. So not the end of the world, but I think there were a lot of factors which made it easier and even pressed all central banks to be able to bring down inflation. And I think it's over. I think we're at a turning point where we'll see higher inflation, not just in the US, but everywhere. Not galloping inflation, but where inflation had been shaded well below 2%, I think in many places it'll be shaded well above 2%.
And it sounds like, if I'm reading between the lines here, Ken, what you're saying is that it's worth it. In other words, that the things you are getting for that higher inflation, the things you listed, for example, are by and large positive things for society and the economy, no?
Well, the things that are happening in the world that I just listed of needing to pay for the green transition, that's just a deadweight cost, no matter how you want to portray it. It's a good thing. I favor it, but it's not a growth strategy. It's something you need to do. Things like defense spending, those are negative things. Redistribution is probably a good thing. Where I think think the Fed is wise to be slow is, there's a trade-off. We could have inflation at 3 or 3.5% instead of 2%, not good, but not as bad as having a deep recession. So Americans are complaining about inflation, but believe me, if we had another deep recession, it would be 10 times worse. And of course, everyone would blame it on the Fed.
Ken, lastly, while we have you, I want to ask you about something quite different, because while most people know you as an economist, some won't be aware that you are also a chess grandmaster, and you have been since 1974 when you earned that title. There is a link between chess and one of the big themes that we've talked a lot about every day, although we haven't talked about it yet, and that is artificial intelligence. AlphaZero was, for many, one of the original big AI breakthroughs back in 2017. It was a computer program developed by AI research company DeepMind to master the game of chess. I'm sure you're familiar with that. So I'm curious about your take on AI, both as it relates to chess, but also as it relates to our lives right now.
Well, first, as it relates to chess, I mean, chess has been at the center of artificial intelligence research since the 60s and 70s. And I knew Richard Greenblatt, who was a pioneer at MIT in the 70s, played his program, Ken Thompson, who's now at Google. And this was one of the most popular events at any AI conference for a very long time. Indeed, as you say, the DeepMind program, which eventually Google bought, was a phenomenal breakthrough. And what's been interesting, I think, to chess players is it just keeps getting better. They thought computers were gods in 2000, and then the DeepMind came along and it was even better. So the rate of improvement is phenomenal. I'll also say that it turns out hasn't been bad for chess. It's actually made it more interesting so far. I hope there are other aspects of our lives which are true, but I think, having seen how fast it evolves in chess, and it's not once. I think with ChatGPT, we've just seen the beginning. I think in 5 years, you won't even recognize how phenomenal it will be. So yes, this has been a long time coming. I've speculated about it for a long time based on chess. And I think we're finally at the dawn of this. I don't want to sound evangelical because I don't know which way it's going to go. But yes, if you look at the experience of chess, faster than you think and for longer than you think, but also not necessarily as detrimental as you might think. Humans have adjusted, and it's been very good.
Well, can you elaborate on that a little bit? You said it's made chess more interesting. How?
Well, first of all, people had thought a lot of positions were boring, that the computer shows, well, try me at this position. And it turns out to be just well springs of creativity, positions where the best player in the world, Bobby Fischer, I think would have maybe even given me a draw back in 1975. Now is the beginning of the game for many players. So this depth of learning, players venture much more complicated and interesting positions because they have other ways to explore them. So surprisingly, we thought it would lead to more draws, right? If you figure it out better, you're going to get more draws. Not at all. So here's this simple compared to human intelligence game, which you would think you would solve out, and yet you find these layers of interest. I think we'll see this in art and many, many things. I don't want to get into the whole socioeconomic ramifications, but I think chess has been the cutting edge and will continue. It gives a hint at what we're going to see with other things.
Kenneth, really fascinating. Thanks so much for taking the time here with us today. Kenneth Rogoff, Harvard University Chair of International Economics and former Chief Economist at the IMF. Thanks so much.
Thank you.
Absolutely. Switching gears here, everyone. Could Governor DeSantis be losing his biggest donor? According to Reuters, hotel entrepreneur Robert Bigelow could be pulling his support from the campaign. Joining us now with more on this, we've got Yahoo Finance senior correspondent Rick Newman. Hey, Rick.
Hey, guys, I feel like a dummy after listening to Ken Rogoff talk about chess, but I'll give it a shot here. So this guy, Robert Bigelow, is a hotel entrepreneur and a billionaire, and he is funding not just DeSantis's presidential campaign, but also his super PAC. That's where the unlimited contributions go. And he has given so far as we know, based on the latest reporting, $20 million to the DeSantis super PAC called Never Back Down. And that is most of the funding that super PAC has gotten based on the latest records. Now, he said recently in this interview with Reuters, he's going to stop donating to DeSantis for the time being. He says DeSantis needs to be more moderate. And he only cited one example, and it was that DeSantis signed a 6-week abortion ban in Florida earlier this year. And he's saying, he just doesn't see DeSantis getting elected in a general election based on positions that are basically out of step with the majority of Americans with that, which those extreme abortion bans are. Bigelow says he's okay with DeSantis's focus on woke capitalism. DeSantis has been going around saying corporations and institutions, universities, they're all too liberal. They need to stop trying to force liberal values onto people. So Bigelow, it sounds like he's okay with that. But if he's stopping these donations, this is coming as the DeSantis campaign is just stalling. I mean, he's making no progress in the polls against Trump. And of course, some Republicans thought DeSantis might end up being the antidote to Trump, a conservative who can actually get elected without all the criminality problems and other things like that. So DeSantis is stuck.
Are we barreling towards a Trump-Biden rematch in 2024, Rick?
I can hear the weariness in your voice, Brad, as you answer my question. Yeah, I guess it does appear to be that way. I don't know. This feels more unpredictable than many campaigns, given that Biden is 80 and Trump is not much younger. And there's all kinds of certainty about Trump with regard to 3 criminal cases he's now facing and probably a 4th criminal case coming in Georgia. So it feels like a lot could change here. I don't know what that could be, but in economic terms, I think this election at this point has more tail risk in terms of changes that could come than it would be if the candidates were in their 50s or 40s, let's say, and nobody was facing criminal charges.
Rick, thanks so much. We'll see. We'll be talking to you a lot between now and then. Appreciate it.
Bye, guys.
Well, shares of Eli Lilly are surging after the company beat street estimates in second quarter results. It also raised its full year guidance. Revenue coming in at $8.31 billion, adjusted earnings per share, $2.11. The pharmaceutical company saw about $1 billion of its second quarter revenue from new products driven by that blockbuster weight loss and type 2 diabetes drug, Mounjaro. Joining us now, Lee Brown, Third Bridge Global Sector Lead for Healthcare. And boy, this has been an interesting space for investors and journalists like us to watch lately, this whole diabetes/weight loss emerging space. Talk to us about what it has meant for Eli Lilly and how important it could be going forward.
Yeah, thank you for having me on. It's wonderful to be here. Certainly a very strong quarter. When you look at the market's reaction, the stock's up over 15% when I last checked. That's really remarkable given its market cap. You're talking over $74 billion of incremental market cap created just this morning. As you mentioned, worldwide sales were roughly $8.3 billion. you're talking about a 28% year-over-year increase. For a company of this size, that's truly impressive. Investors are happy. I think it is important to note that that growth was driven not by just Mounjaro, but a collection of drugs that are performing well. We've got Verzenio, Jardiance, and Taltz. This is not even talking about the potential of donanemab, which is their Alzheimer's candidate. So really firing on all cylinders at Lilly.
And your specialists have some excitement around Verzenio. Explain that and walk us through that excitement and why this could potentially impact and have a good contribution to sales trajectory.
Yeah, I hate to jump off the GLP Mounjaro chain so soon. Well, I know we'll get back to it, but Verzenio is what's called a CDK inhibitor, and we're seeing a lot of use is in adjuvant care. So it treats advanced or metastatic breast cancer. It's continuing to post strong growth. It was up nearly 58% year over year in Q2. Sales close to 930 million. That compares to first half sales of nearly 60%. So this is a drug that not only is producing a blockbuster type of revenue, but growing at north of 50% in the quarter.
I do want to circle back, indeed, as you expected, to these diabetes, obesity drugs, because, of course, there was also the news today from Novo Nordisk that a study of its treatment, Wegovy, also cut the risk of heart attack and stroke by, 20% in a study. We know Mounjaro is undergoing a similar study here. Given that we have already seen the sales that we have seen for this class of products, studies like this, how much more of a boost could we see?
Well, I think what's interesting is we have a huge market opportunity. There's somewhere north of 650 million people globally that could benefit from GLP-1s, either through a type 2 diabetes indication or through what they like to call weight management. So this is certainly helpful. And I think what's really exciting is payers are getting on board. Something like 73% of prescriptions were covered in Q2. This shows that this is being embraced. It's not something that's looked at as sort of a failure. In terms of, hey, you need to get out and exercise. This is looked at as a helpful medication to get people healthy again and ultimately save healthcare system dollars. I think what's interesting when you mentioned the cardiovascular risk reduction, that's one of the things that's been benefiting Jardiance, one of Lilly's other type 2 drugs. It's performing really well. Its Q2 sales were nearly 670 million. That was up 45%. And in large part, in my view, in our specialist view, due to the reduced risk of cardiovascular death in patients not only with type 2 diabetes, but with chronic heart failure, what they call CHF. So it'll be interesting to see as they progress with Mounjaro, whether they'll demonstrate a similar effect. I suspect it will.
For someone who is a layperson on all of this, Lee, do they reduce this heart risk because they are taking people's weight off, or are they also sort of more directly addressing the things that cause heart attack risk in the body?
That's a great question. I'm not a doctor, but I can tell you that their next gen GLP-1 that they're already working on, which is exciting, retatrutide, that demonstrated mean weight reduction of up to 24% at 48 weeks. Where am I going with this? That was in their phase 2 trial. They're going to move it into a series of phase 3 studies called Triumph. And what's interesting about this is they're not only going to evaluate the safety and efficacy in chronic weight management, but also obstructive sleep apnea and as far as knee osteoarthritis. So you can imagine this is more of a weight reduction class effect when you think of the benefit of retatrutide potentially working for sleep apnea and osteoarthritis.
Is there anything that you see coming down the pike that could slow down the growth of these drugs? There has been a little bit of a sort of cultural backlash, right? But is there anything meaningful that could happen?
I'd actually think the cultural reaction has been one that's been embraced. There was an article just this morning in my inbox discussing whether to lose just a fair amount of weight or a light amount of weight was okay in the use of GLP-1. So, and you look at the reimbursement coverage coming along, that was a big question. I think people are on board with this. You're also seeing class effect across drug distributors and also within managed care. Cigna had mentioned the benefit of this through their PBM, their pharmacy benefit manager. McKesson had mentioned it, AmerisourceBergen, both gigantic drug distributors. So everyone's enjoying the benefit of these GLP-1s, and they're creating a healthier society. I don't think we should have negative backlash unless we start to see some safety signals, which we really haven't seen so far.
And just lastly, and super briefly, when we think about regulation around some of the drugs that have been shown to have more weight loss side effects, is there anything that investors should be keeping an eye on, how this is catching the attention, not just of potential customers, but at the same time of some of the regulators?
Yeah, excellent question. And not just regulators, but reimbursement coverage. I think as this class of drugs continues to scale and the amount of healthcare spend it encompasses, there's always going to be pushback on pricing. Senator Bernie Sanders had already talked about this, sending a letter to HHS, Health and Human Services. But these are brand new drugs. They're performing tremendously. They have patent protection, and these companies deserve a fair return for their extraordinary R&D investment to produce these. In terms of regulators, there are GI, gastrointestinal safety warnings, so folks need to pay attention to the warnings. Novo's also looking into some nominal instances of suicidal ideation. Looking at the safety profile in totality, I'm really not seeing anything to be concerned of at this time. As the drugs are used by more and more people, we might need to focus and see what comes out of that.
Lee, really helpful perspective on all of this. Thank you so much. Lee Brown is Third Bridge Global Sector Lead for Healthcare. We got much more markets action coming up. Stay tuned. You're watching Yahoo Finance.
From Taylor Swift to Beyonce, Concert goers are dropping thousands on the shows of the summer. And the ticket sites like Vivid Seats, they're capitalizing, with the company seeing record gross order volumes for the second quarter. Vivid Seats CEO Stan Chia joins us now. Stan, great to see you. I got to imagine that this is a type of rip your face off volume activity that you've been experiencing over at Vivid Seats.
Good morning. Yeah, thank you for having me. Look, it's a great time to be in the industry. We sit in a really privileged spot where we get to provide a platform to consumers who love going to live events, and I think we're really excited about everything we're seeing on that front.
And then additionally here, just as you think about the two aforementioned superstars in Taylor Swift and Beyonce here, I mean, largely when you think about the consumer environment, even for the purchases that we've seen at these ticket prices for artists like Beyonce, like Taylor Swift, what does that tell you about the state of the consumer?
Everything we're seeing is that this consumer remains resiliently strong, is what I would say, in the face of what we're hearing around the rest of the economy, whether it's Taylor Swift, whether it's Messi in sports, whether it's Lollapalooza, which was right here in Chicago, where we're headquartered. You know, we're continuing to see strengths across all the categories.
Can you tell us how much Taylor Swift and Beyonce in particular made up of your volume?
Look, I think for us, you know, we see such a breadth across our offering. When you look at Vivid Seats, again, you know, we have every single event that's out there, from concerts to music to sports. So I'd say, you know, every one or two artists really aren't enough to represent the whole. But certainly in terms of Taylor Swift and Beyonce, when you think about them relative to others, they are certainly sizably larger than what we've seen in the past.
Can you tell us breakdown of sports versus entertainment?
Yeah, I think, you know, we see the industry as about historically 60% sports and 40% concert and theater. For us at Vivid Seats, we've continued to index higher on the concert side. And, you know, we're probably closer to 60% concert, 40% sports.
And even with that breakout, when we think about the impact on local economies, what type of multiplier have you seen from events for the broader impact for the local economies as well that they're within? I mean, people are traveling to see Taylor Swift, Beyonce. I traveled to see a concert this year. I mean, that was part of my travel plans, I guess. But all these things considered, I mean, there is a huge impact.
Yeah, I think, look, back to the strength of the consumer continues to ripple into other things, and we're privileged to be in this spot. You know, we just looked at Lollapalooza, for example, in Chicago, 4-day festival. When we looked at where people traveled from to get there, it looks like they're traveling 33% further than they have last year for that. And I'm sure that ripple is the same across multiple events and categories.
Stan, how sustainable is all of this, right? I mean, yes, people are really excited to go see some of these concerts from artists who have not been touring. And even if they continue to tour, are people going to be willing to pay the same premium to make those travel plans that you're talking about? How much do you think that's going to last?
I think we are at the start of, you know, what we call secular tailwinds towards the sector, where I think people really are prioritizing their spend towards live events. So I think we love that. When you look at Vivid Seats, what we're doing in particular, you know, I think we've invested in a lot of things on our platform that we believe will help consumers as they look to make purchasing decisions and go to more live events, whether it's our best-in-class loyalty program, or we have a buy 10, get one free ticketing program. We have been recognized by Newsweek as best customer service. We now have Game Center as a place to engage and win free tickets. So, you know, we continue to see strength, and we continue to also invest in things such that consumers find value in the platforms in addition to the events that they're going to.
You gave us a year-over-year comparison just a moment ago here, and I'm wondering, you know, since some of these massive concert dates were listed, like Beyonce, like Taylor Swift, what kind of increase in volume or traffic have you experienced?
Yeah, we're really proud of our results, you know, in particular for the quarter. If you look at that, you know, we're up versus the street, certainly 20% on GOV, up over 20% on EBITDA. And as we look at, you know, what we're guiding to, you know, I think we guided up more than our outperformance in the first half of the year. So I think we continue to see strength. I think we're pretty excited about everything we're seeing on the platform.
All right, who's the next concert you're going to see, Stan?
Hey, I'm going to Guns N' Roses in Chicago. They're here August 24th. I'm a big hairband guy. I'm looking forward to it.
All right, report back on that. Stan Chia, Vivid Seats CEO. Thanks so much, Stan.
Thank you.
All right, everyone. Well, coming up.
Coming up, Michelle Lagufo's got you covered for the next hour of trading.
And we've got much more. Stick around for the next hour of market coverage with Rochelle, aforementioned. She'll be talking China, where things aren't looking too good on growth. The country saw its exports drop more than 14%. That's according to a new JP Morgan report. We'll be joined by JP Morgan's Gabriela Santos to dig into that report. Also, Kindral CEO Martin Schroeder is going to be sitting down with us. The company just released its quarterly earnings, 18 months on from its spinoff from IBM. So what's happening with the company and how was it weathering all of these economic headwinds we're going to be finding out as well.
Yes, we're also going to be digging into the state of the real estate market and the historically low inventory levels of homes on the market right now. That's going to be with National Realtor Association's Lawrence Yun. We got a lot of interesting things up ahead. Guess what else? I'm going to talk later today to the CEO of Tilray, Irwin Simon, on the heels of that company's purchase of 8 beer brands, or actually 1 energy drink brand, 8 drink brands from Anheuser-Busch. So you don't want to miss that. That's coming up at 3 p.m.
All right, market's down. We're done. Rochelle up next. Here's a live shot of New York.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Lagufo's. Here's a look at what I'm watching this morning. China's exports plunged 14.5% in July amid slowing global demand, what a new report from JP Morgan says about the state of the country's economy. And shares of Kindral are spiking today after the IBM spin-off raised its full-year forecast. We'll speak with the CEO later on this hour. Plus, AI seemed to drive big tech earnings this quarter, but will the trend continue? We'll discuss that coming up. But first, let's take a look at how the markets are faring an hour and a half into the trading day, continuing to see this sell-off here as we saw Moody's downgrade a number of banks, rattling a little bit, and then also seeing this collective draw of breath ahead of CPI data coming out this week. The Dow now off more than 410 points, they're about just over 1%. The S&P also being weighed down about 50 points, or more than 1% as well. And the tech-heavy Nasdaq, they're down more than 1.5%. They're losing more than 200 points so far this morning. Let's also check in on the treasury market as well. We know we're seeing some rebalancing this week when it comes to the bond market. We're seeing the 5-year pulling back that you see down more than 1.3%. The 10-year, as we can see, right at that 4% mark now, down 1.9%. And the longest term 30-year yields, that's also down about 1.75% on the day as well. Well, concerns over China's recovery are growing. Imports and exports for the world's second largest economy fell in July at the steepest pace since February of 2020. Now, China's imports are down more than 12% in the last year, and exports contracted 14.5%. The grim trade data continues to fuel Wall Street's expectations that China's economic activity could slow further in the third quarter. Well, our next guest just helped publish the Guide to China. Joining us now is Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Great to have you on the show here. So, looking at some of the highlights from this China guide here, I mean, we're seeing obviously the US dollar rallying on some of the weakness that we saw in China's exports and imports. But give us an idea of some of the data that you're focusing on at the moment as investors try and wrap their heads around this recovery from post-zero COVID that just doesn't seem to be taking hold.
Thank you, Rochelle. Good to be on. And we created actually this Guide to China a couple of years ago together with our colleagues in Shanghai and Hong Kong because there's a lot of noise around China usually. So it's really a way to focus on the signal. And for this year, for China's recovery, it's really important to remember that this is the first time this is a China recovery that's expected to be led by domestic demand, not external demand, and by household consumption, not infrastructure and manufacturing. So the places we look for confirmation or lack thereof of that recovery are different. It's a very unique recovery. So from the report this morning, for example, I would focus less on the exports. Those were always expected to subtract a bit from Chinese growth this year. We're buying less stuff, right? Apparel and electronics. And I would focus a lot more on the weakness in imports, double what was expected for July. That's a signal that domestic demand is not picking up as expected. So really that's our focus. Where do we look for an eventual bottoming in domestic demand? And that's especially more related to household consumption and confidence, which could be a forward-looking indicator of whether we get a bounce back in the second half.
And that really does speak to President Xi's dual circulation strategy. They wanted to be less reliant on some of these foreign imports, more reliant on domestic consumption. But China historically is a nation of savers, and they don't seem to be buying into that consumption narrative. What are you finding as you dig into the data?
So it's really interesting. As you say, Chinese households are savers. They tend to save historically about 35% of disposable income. That compares to the US, for example, where we save about 7-8% on a normal year. So structurally, they're bigger savers. And to try to change that mindset in the long run, China really needs to build a social safety net, for example, so households don't have to save so much themselves. But I think for this year, what's also going on is that households had built extra excess savings during the 3 years of the stop-start zero COVID policy. So there's about 3 percentage points extra in savings as a percentage of disposable income. One way we look at that in the report is by looking at household deposits at banks, which doubled over the past 3 years. And what we're seeing is households are getting out and about. Mobility is back to normal, but they're not spending as much as we expected. It's very, very targeted on things like what we would call catering, so restaurants, also travel and leisure. But the spending has not broadened out further, especially not related to anything related to the housing market. So things like furniture and decorations, electronics, appliances, that hasn't picked up yet. So the linchpin really for this year to unleash those pent-up savings is household confidence needs to pick up, and specifically around the housing market. So that's where policymakers are focused on next.
And as we look at how investors are viewing this, I mean, when you look at some of the deflationary pressures that either people are trying to manage right now or that they're bracing for, what should investors keep in mind? We're going to be getting even more inflation data also coming out this week from China.
Indeed, we will probably get the inflation data overnight, and we might see a deflationary print year over year. And this is really a reminder to investors that there are a couple exceptions to this high inflation, monetary tightening narrative that we have around the world for the past year and a half. And that big exception is China. China has not faced inflationary pressure, and it's actually doing the opposite. It's providing monetary and fiscal stimulus in order to boost the recovery. It was already doing that going into this year, but it's picking up even more given that the data around domestic demand and confidence has disappointed in the second quarter. I think what investors got excited about over the past couple of months, when Chinese stocks have rallied about 10% since their late May lows, is that Chinese policymakers are now getting even more targeted with their stimulus measures because they understand they need to boost confidence. So they're engaging the private sector more. They're announcing the end of regulations that they were doing, especially around the tech sector. They're trying to provide stimulus to households to buy big ticket items like electronics and electric vehicles. And lastly, what investors are watching this month are policy measures around real estate to try to arrest some of the recent depreciation that we've been seeing, not just in activity, but in home prices. That's really a linchpin. That's what can sustain the recovery, not just in China's economy, but in Chinese markets in the second half. And we do expect that to happen and to be a positive tailwind.
And we did note that although we see a lot of talk about, at least in the media, about companies pulling out of China, didn't seem to see that quite as reflected. There was obviously some downturn in terms of the people that were surveyed, making some considerations about moving operations from China. But it does seem people are still in China for the long haul when it comes to at least conducting their businesses. For global multinationals, for investors in those spaces, what's one thing they should keep in mind?
I think it's a big rethink of how companies think about China. It used to be made in China to export to the rest of the world. Now it's made in China for China. So companies are not leaving China altogether. They're leaving their manufacturing there where the end consumer is the Chinese. And remember, this is still the second largest consumer market in the world, where consumption growth contributes about a quarter of all global consumption. And that's only set to increase as China is expected to double its GDP per capita, bringing another 400 million people into the middle class over the next decade. So really what companies are thinking about is, if my end consumer are Chinese consumers, I'll keep that production in China. But with my new production, if my end consumer is somewhere else, I'll have a China plus one strategy. And that's where opportunities are already picking up for places that can absorb that production. And we see interesting opportunities, for example, in Vietnam, India, Thailand, and Mexico that can pick up some of that overflow from China.
I do appreciate you joining us with that fresh report out this morning. A big thank you there to Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Thank you so much.
Thank you so much for having me.
Well, artificial intelligence was the hype factor driving tech earnings in the first quarter. Is the trend continuing? Joining us now is Yahoo Finance senior tech reporter Dan Howley. So Dan, what are you watching?
That's right, Rochelle. Throughout the kind of earnings that we've seen from some of the bigger tech firms, they continue to mention AI as a either reason for growth or potential for growth. We talk about Microsoft at first. They spent a good time discussing AI. Obviously, CEO Satya Nadella really digging in on AI for the first half of the year with their kind of partnership with OpenAI and the various products that they've launched with AI capabilities. And so he really dug into that during the earnings call, providing investors and analysts with information on the different products that they're launching and have launched, discussing the Microsoft 365 Copilot pricing of $30, how that's going to be a boon for them. And then for Google and Meta, they seem to focus more on how AI is driving their advertising business. Now, Google also touched on how it's pushing enterprise. Meta discussed that as well with WhatsApp, but really the focus seemed to be on advertising and how AI is going to improve that, whether that's through the search generative experience. That's the generative AI version of Google Search. That's an experiment right now, or with the ability for advertisers to put together ads more quickly with generative AI on Meta's side of things. So they both, as I said, had enterprise discussions in their calls, but the bulk of it, or at least the front load of it, was on advertising. And then for Amazon and Intel, they were speaking more about the opportunity that AI provides. Andy Jassy going over how AWS, the company's own custom chips and inferences, as well as its Bedrock platform, are going to be big pieces of their AI capabilities moving forward. And Intel's Pat Gelsinger mentioning how the CPU side of the server business is still sluggish, but then moving forward, there's a larger total addressable market that they'll start to see in 2024 and beyond. So a lot of these companies obviously continuing to focus on AI. I mean, if you go through their earnings reports and you do a control search for or control F for AI, it's incredible how often they mention it. The one big company that doesn't mention it is Apple, and they did that again in their most recent quarter. The only time, in fact, that Tim Cook actually talked about AI was when Deutsche Bank analyst Sidney Ho had brought it up, asking where he sees the company, where Tim Cook sees the company taking advantage of it. And he basically said, yeah, you know, it's built into all our products. That's just how we roll. And that's just Apple's MO. They're not going to talk up the technology. They're going to talk up the products that the technology powers. So yeah, a real kind of continuation of the themes we've seen for AI for these big tech companies. And then, you know, we also had Palantir release their report. They're a big AI player. Focus on AI. They're a data analytics firm with AI backing their capabilities. They're not going to be as big as something as Google or Microsoft. They're more focused on governmental contracts, things along those lines. But they did boost their outlook for the full year. So AI clearly continues to be a big play going forward.
And certainly high standards indeed, with some analysts divided at least, though, calling Palantir the Leo Messi of AI. We'll have to see about that. But a big thank you there to our very own Dan Howley. All right, well, I'm watching shares of Lucid. The stock surging today after initially stumbling following the report of its second quarter results. The EV maker missed analyst expectations on earnings, reporting a loss of 40 cents per share on sales of about $151 million. The company also disappointed on deliveries, which weighed on the stock in after-hours trading as well. Well, this morning, though, Lucid unveiled the final specs for its Air Sapphire. The luxury electronic sports sedan is meant to rival Tesla's Model S Plaid. Now, the company says it will pack a whopping 1,234 horsepower and go from 0 to 60 in 1.89 seconds. Can't wait to try that one out. All right, well, stay with us. We have all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What's the story that we're not talking enough about this year?
I think it's moderating inflation and the impact that's going to have on pricing. We're starting to hear companies talk about that, but I don't think investors totally understand the impact on earnings for next year.
Let's do a check of the market sponsored by Tasty Trade. Some of that selling action slowing down ever so slightly, so just barely off the session lows though. The Dows, we can see they're still off more than 370 points or down more than 1%. S&P also down about 50 points or about 1.1%. The tech-heavy Nasdaq also down though, more than 200 points or 1.5%, especially some of those Moody's concerns over the banks and of course that pullback from China, some of that sluggish data pointing at deflationary pressures as well. Well, back in 2021, investors saw a spin-off of the multinational technology corporation IBM successfully enter the New York Stock Exchange under the name Kindral. Now, Kindral is comprised of a bulk of former IBM services with a portfolio of over 4,000 customers, and they just released their earnings on Monday. The company saw a beat on its top and bottom lines, seeing a payoff from its 3A strategy that pursues alliances, increases automation, and eliminates accounts with substandard margins. Let's bring in Kindral CEO Martin Schroeter, as well as Yahoo Finance's Brad Smith, to discuss this. Welcome to the show here. Still seeing the stock here enjoying some of those gains this morning. Dig into some of this, because we know all of this excitement also stemmed from that fiscal 2024 adjusted pre-tax income, as you're projecting there, of at least $100 million. What's going to get you there?
Yeah, thank you. Thank you for the time, and thank you for the opportunity to talk a bit about Kindral. As you noted, we're executing a very clear strategy around our alliance activity, around our automation, or what we call advanced delivery, and around focus accounts, which is focused on getting a number of the relationships we inherited onto a longer term solid economic footing, which our customers are very much interested in as well. And each of those contributed quite nicely in the quarter, and each of those gives us increasing confidence about how we travel through the rest of the year as we continue to execute, as we continue to drive both a bit of top line growth from the alliance activity, but importantly for us, and a real focus for us, to get our margins back to where we think they should be, at kind of a high single-digit profit margin level. So we feel great about the start. We obviously started and got ahead a bit faster than we thought in our prudent guidance from just 3 months ago. But this is the right strategy for us. It's a strategy that's working, and it's a strategy that can work to turn around Kindral to a revenue growing company, and one with pretty solid margins.
Hey, Martin, Brad here. Just wondering, as you think about some of the high growth areas at the business, particularly cloud automation and AI, for AI, there's been so much of the hype phase that has really come about in the previous earnings season, and some of that has continued to transpire in this earnings season. I'm wondering how much of that demand you're seeing among your client and portfolio base right now.
Yeah, look, AI is certainly, for us, is certainly here, and it's present in the way we deliver our services to our customers. We have AI embedded in our open service delivery platform called Kindral Bridge. So our customers are already benefiting from insights from both our AI, plus we have the most data on how this infrastructure runs across these disparate infrastructures. So we are providing insights to our customers today using our AI, using our machine learning. It's helping us automate a lot of the delivery that we currently provide, which allows our teams, our deeply skilled engineers, to go work on other things with those customers. So it's here and now in how we deliver. It's also very much part of the discussion when we think about our Kindral Consult business, because our customers are looking to make an AI journey. They're looking to understand how can they use AI. And in order to do that, your infrastructure has to be ready. So you need data architecture help, you need security, you need resiliency. Even if you're just going to start a series of what I'll call science experiments, you need the infrastructure to be there and supportive. You need your data to be secure. You need your data to be in the right spot. So you'll see from us in the next couple of days announce another very close partnership with Microsoft on helping our joint customers start to travel down that AI journey as well. So it's here in how we do our work today. It's here for how we're advising our customers. It is more than just hype. There is something coming, and for our customers who are just starting these discussions, it is something that's coming that we're all going to have to figure out, how do we use it.
And Martin, you're in an interesting position here because since spinning off, you get to sort of move like a startup, but then you also have these Fortune 100 clients and partnerships as well. Does that add extra pressure, or do you feel like you have a lot more freedom when you're trying to reimagine these infrastructure services?
Yeah, it's a great question. And look, a big part of the benefit of being independent is the freedom of action we get, the freedom of action to build the kind of culture that a true great services company wants to be, to really be devoted to your customers in a way that allows you to align our outcomes with their outcomes. So the freedom of action is a really big, important part because it allows us to partner with the most important customers, most important partners in enterprise tech space, which we just, as part of IBM, we were entirely focused really on the IBM space. And so this freedom of action not only allows us to engage customers in new ways, it also gives us the ability now to invest and build things like as I mentioned, our Kindral Bridge, our open service delivery platform. It allows us to show up with our customers with new design-led Kindral Vital approaches to how we put together solutions for them. So you're spot on. The freedom of action we get is a big part of why we're doing well. It's a big part of why our customers are really excited about taking the journey with us, because we're now part of the ecosystem that matters to them. We're showing up with new capabilities. We're investing in our business, and we're bringing them innovation now, and we're allowing them to take advantage of our innovation. We made an announcement, it was a couple of weeks ago now. We have over 500 customers on Kindral Bridge already, and we estimate we've saved them about $1 billion just from how their infrastructure runs using Kindral Bridge, and we'll have about 1,000 customers on Kindral Bridge by the end of the year. So freedom of action is a big part of what allows us and will allow us to be successful over the long term and really deliver value to our customers.
Martin, I'm going to continue to do some deductive reasoning around that announcement that's going to be coming in just days from now that you teased a moment ago with you and Microsoft here. But in the meantime, as you were talking about customers, naturally the thought goes to what is the spend profile of some of the customers that you're seeing be net new versus those that are existing customers and already within that kind of portfolio of clients here, especially considering most of them just about 6 to 9 months ago, we're talking about cost restructuring and how they needed to navigate this near-term environment with kind of cost scrutiny of their own that they were deploying.
Yeah, look, I think that environment is always going to exist. I don't know of any, at least our customers, our customers they're the big important customers that run the bank, that make the banking systems work, that run the supply chains, that run the airlines networks of the world. So I don't think any of our customers have ever been like profligate in how they thought about where they were going to allocate their capital. Obviously, a macro environment where they're expecting a slowdown would change their opinion again. But for us, and the nature of the work we do, we run mission critical. And so for us, we are fairly well insulated from the perturbations of the macro. And I will tell you that even in a macro environment where some of their discretionary work may be being pushed out or rethought or reprioritized, the nature of mission critical is just that. And you always need to be secure. You always need to be resilient. So no matter what the macro is, there is no recession coming in cybersecurity. No matter what macro there is, there's no recession coming in cyber resiliency. And again, because of the interest in AI and whether you think the economy is going to slow for a month or a year, everybody's getting their business ready for that wave that's coming, and we're at the front end of that now, which is how do you architect your data, how do you make sure it's secure, et cetera, et cetera, et cetera. So we sit in a slightly different spot from many others in tech world, and we do sit right in the center of mission critical, which for us again sort of it makes us a bit more resilient, I think, than what others might be experiencing.
I do appreciate you taking the time to join us this morning. Kindral CEO Martin Schroeter and, of course, our very own Brad Smith. A big thank you to you both.
Thank you.
All right, we have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
Amid a budding surge in long-term rates, the US Treasury surprised investors last week by upping the size of several Treasury auctions taking place this week, including a $42 billion auction in the 3-year tenor at 1 p.m. today. Now, for the latest, we turn to Yahoo Finance's Jared Blickery. Hi, Jared. I know you're covering all of this for us, so where do things stand?
Yes, a lot happening in the bond market recently. And as you just said, we have a $43 billion auction, or 42, in the 3-year tenor. That's coming up in an hour and a half here. But we also have a 10-year auction tomorrow, a 30-year auction Thursday. Altogether, that's $103 billion that's only bonds. When you take into consideration what's happening in T-bills, that's an extra $222 billion. So that's a lot of cash that is being sopped up. And as you also said, the auction sizes for a lot of these have been increased. And this is coming at a kind of precarious time of year. I'm going to get to, let me just show this now. This is bond market seasonality. So this has to do with the liquidity in the Treasury market. And as you can see, here's August. We got January through December. August takes a dip. And usually what happens when you have lower liquidity, that means increased volatility. And that, of course, means some hinky price action. Now, it's not always like that because, as you'll notice, December is by far the worst month for liquidity. That takes into consideration the Santa Claus effect when a lot of nothing tends to happen. So it's not always bad. But when you take into consideration, too, that we tend to go flat in equities this time of month or this time of year in August, and we also have the VIX seasonality. I was showing this in an earlier hour that VIX seasonality points to an increase in the VIX. Well, you put it all together and we have the makings for a little bit of a sell-off here. So let me show you the VIX. This is in equities. This is the fear gauge. You can see we have now hit today the highest level in 2 months and maybe a week or two. Here is the VIX of the VIX, the third derivative, fourth derivative. That's spiking up a little bit as well. And what I like to show is the ICE B of A move index. This is bond market volatility. This is as of the close. So yesterday we retraced to the downside. That's that red candle, the movement to the upside, but it was a breakout, and we're going to have to see what happens today later on. Finally, I just want to show you what's happening technically in the 10-year T-note yield. You'll notice, and this was the surge you were talking about in the intro, we got pretty quickly back up to over 4%, and we're holding the 4% line right now. Let's take a look at what happened over the last year when we reached that 4% mark, and we've done it 3 times. So you go back to last October, last November, we got a downdraft after peaking above 4%. Then in March, we did a similar thing, and that was right around the internet banking panic. And then recently, we got a little bit of a sell-off here, but we're back up again. And so I think if we break this trend line to the downside, it's going to be about 3.8, 3.9%, probably in line for another decrease in these rates. But if we keep going up here, there's going to be a huge surge. You could call it a short covering rally if we were to go materially above 4%, and we could get back to 5%. These are levels we have not seen in quite some time, Rochelle. So some pretty big catalysts on the horizon.
And certainly a big week indeed for the bond market. We know you'll keep us honest with all of that. A big thank you there, our very own Jared Bleckery. Well, it's getting harder for Americans to purchase their dream homes. Persistent inventory challenges are continuing to create challenges for home buyers. In the month of June, the U.S. registered its lowest inventory count since the National Association of Realtors began tracking this data since 1982. Well, our next guest says 2023 could go down as the tightest inventory market conditions to have ever been recorded. For more on the state of the housing market, we're joined by Lawrence Yun, National Association of Realtors Chief Economist. Great to have you back on the show here. So let's break down some of this data, because I know you've said that the recovery hasn't taken place, but the housing recession is over. So where are we now, and what breaks this holding pattern?
We are in a very unique housing cycle. We saw the buyers pull back initially when the interest rates were much higher, but now the buyers, multiple offers are happening, but the supply is not there. At the same time, the builders are having great time. They're making profits. They're building those empty new units, and they're able to find buyers. So we are in a very unique circumstance, but the inventory clog up, that is holding back the potential for recovery.
And how quickly can home builders ramp up production, especially when you're factoring needing to hire workers and to try and meet some of this demand?
The cost of construction is rising. So one has to consider, the building permitting process, which may take a very, very long time, especially in some states like California, which will hinder a continuing supply situation. But what really needs to happen is, can we find an incentive, tax incentive, to unleash some of the inventory held by mom and pop real estate investors? There are over 20 million single-family housing units that are rented out. But if we can get even just 1% of those inventory onto the market through tax incentive, essentially reduction in capital gains tax, if it is sold to, say, first-time buyer or with some income limitation, that will spur more supply immediately, and that will help the housing market and the broader economy. So that will be one consideration I think the Congress should seriously consider. But in the meantime, it's about the builders and maybe changing housing family circumstances. Some people have to move, new job, new child, maybe changes in their marriage status, getting married or divorced. All that will also lead to some addition in the supply just from long-term demographic factors.
But how likely is that to happen? We already have a very tight labor market. Nobody wants to have to then now take on a higher, mortgage interest rates as well. What sort of timeline could we be looking at when we might start seeing meaningful loosening in terms of the inventory that's out there?
So it's a gradual, steady improvement in inventory, but the big change is either that tax incentive or if the Fed decide to stop raising interest rate. Because one of the reasons for the low supply is that homeowners do not want to trade away their low interest rate for much higher interest rate as they are making their residential movement. But if the interest rate begins to calm down a bit, at least the cost of the move becomes less painful than before. So we could encourage more people to move also by the Fed stopping raising interest rate, especially in light of the fact that Fed has really damaged the regional banks, small size banks. I mean, the big banks are fairly immune, but small size banks are important for the country, and we cannot further damage the balance sheet of the small size banks.
And it certainly doesn't help. We're already seeing, some weaknesses in those regional banks. Moody's downgrading some of the larger banks as well today. But when you look at what people tend to look at, which is the 30-year fixed mortgage, some of the projections for the NAR, 6.4% this year, declining to perhaps 6% in 2024. How much of this pent-up demand are we going to see then start to get released by then?
Oh, yeah, you will see a rush of buyers coming in with lower interest rate. But also, good thing is, again, some of the homeowners who are really liking their low interest rate, well, if the interest rate comes down a bit, they are willing to give up their 3-4% mortgage rate, which they locked into a few years ago. So low interest rate will not only unleash demand, but it will also begin to unleash supply situation.
And Lawrence, where are the deals to be had? Because a lot of people, purchased homes to use as Airbnbs or secondary homes and rentals as well, and, feeling some pressure there as well. Where are the deals to be had regionally in the United States?
Regionally, the Midwest, the most affordable regions of the country, you look at, say, Cincinnati, Indianapolis, the typical median home price at around $250,000. So someone from, say, coastal region, whether from, say, California market, New York, they go into the Midwest, they can buy all cash at times, or the mortgage payment will be very, very manageable. And the job growth in the southern states are very, very strong, whether from Florida all the way to the Carolinas or Texas. Strong job growth is adding to that demand.
There's certainly some deals to be had, but obviously you have to be strategic and know where to look. A big thank you there for breaking that down for us, Lawrence Yun, National Association of Realtors Chief Economist. Thank you for your time this morning.
Thank you.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is what's next for Samsung.
People put it in the water.
That's pretty gnarly.
Water.
Innovation is changing our world.
This is the heart and soul of Astrobotic. This is where we build our landers that go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series next.
The Nasdaq is up 30% this year so far, with the big tech companies from Amazon to Meta driving the growth. Now, investors point to several big factors that have helped the companies flourish. The generative AI boom and, of course, significant cuts made to their margins and their workforce. Let's bring in Yahoo Finance's Ali Garfinkel to tell us about the metric that she thinks we're not talking about enough that's driving this rally. Hey, Ali.
Rochelle, this rally has been all about cutbacks, and the most visible place we've seen that has, of course, been layoffs, which we've talked about substantially here on Yahoo Finance and at large in the media. However, I think it's important to talk about something else that is a little bit nerdier: capital expenditure cuts, right? We're seeing them this year and late last year. Now, remember, CapEx is what companies are spending on their future, right? Long-term assets, technical infrastructure, offices, intellectual property, copyright, trademarks, that sort of thing. And all of these tech companies, they're doing it in their own way. But it's uncanny that it's happening. Some examples for you here. Late last year, Amazon has been cutting CapEx in its retail business, for example. So that's a specific case. Whereas you have something like chipmaker TSMC, which is cutting its CapEx this year by as much as $4 billion. Now, the case I want to end with is sort of a study in contradictions. Meta. On one hand, you have Meta's growth being cheered, while it's also spending a lot of money on reality labs. Last year, for instance, it spent $13.7 billion on reality labs. However, what's happening? That CapEx is getting cut. This year, Meta is spending $1.4 billion less in its Q2 CapEx as opposed to last. You see where I'm going with this. Meta is spending more this year is spending less this year on CapEx than it is last year. You see where I'm going, right, Rochelle?
I feel you. I feel you on this. And so then when we put all of this together then, Ali, what does this say about how investors should think about growth of these tech companies moving forward as they're still making these investments, but more strategically?
I think tech is in a complicated dance on this, Rochelle, right? On one hand, you have money getting more expensive, the pressure to cut back on spending. And on the other hand, there's still this tech drumbeat growth, right? A banker I was talking to just yesterday said, growth is still important in tech. It's just sensible growth. What I would say right now is think about the fear, the anxiety surrounding the cloud slowdown, right? You have something like AWS, for instance, seeing growth decline over a period of years. And what sort of happens there is everyone gets scared. So it's the sort of, what I would say right now is tech is walking a growth tightrope. There has to be some growth, but there can't be too much spending on it either.
Indeed, that is a tight line to try and walk there. Lots of great stuff there. Appreciate that. Our very own Ali Garfinkel. Thank you so much. Well, the markets have been weathering several storms as of late, from central bank policies, rating company Fitch's downgrade, and of course earnings. Overall, a majority of investors, though, seem to be trailing away from seeing a harsh recession, opting for seeing a soft landing after months of economic headwinds. However, according to our next guest, we might not be that lucky. We're in for a bumpy ride. Let's bring in Invesco Chief Global Market Strategist Christina Hopper to discuss more. So, Christina, you're not buying a lot of this soft landing narrative that we suddenly started to see coming out from some of these analysts. What's your take?
Well, Rochelle, I should preface my comments by saying I've believed all year that we're in store for a bumpy landing, not a hard landing or a soft landing. What's changed is the views of others around me. I had been an optimist at the beginning of this year. Now I'm more on the pessimistic side because so many have signed on for a soft landing scenario. My argument, though, is simple. It's that you can't have such aggressive rate hikes without some economic damage. It doesn't mean there has to be a lot, but what it spells is a bumpy landing as opposed to a soft landing, which suggests that there's no real damage that occurs to the economy. We may not see that damage for some time because of the lagged effects of monetary policy, but I do think there are going to be areas of the economy that are hurt by these aggressive rate hikes.
And what are you going to think are going to be the first shoes that are going to start to drop that would have people realize perhaps this isn't going to be the soft landing they were expecting?
Well, it's hard to predict, but of course we've already seen some accidents. We saw the regional bank mini crisis, and we're certainly seeing Some areas of real estate come under pressure. But the reality is that we just don't know. I think of it as not so much black swans, but gray rhinos. Issues that are out in the distance that could be coming towards us or could run off in another direction. There could be some black swans, although I should say, again, my view is not a hard landing for the economy. I'm actually, I think, fairly optimistic, but realistically so, which is that because we have such a strong consumer, because we have such a tight labor market, this economy has a really good cushion as it handles and tries to weather the headwinds coming from rate hikes.
And of course, we're still getting a lot of Fed speak out this week as well. How is that informing how you're viewing the road ahead? I mean, especially when we think of this idea of the potential for more disinflation.
So my view is that the next few weeks are critical, and that's what Jay Powell said at the FOMC press conference in late July. So this data is going to be very important because the Fed is very data dependent. I suspect the Fed will not have to hike rates any further, but I do worry that it will feel the pressure, the need to do it because of data points like average hourly earnings, what we got from the July employment situation report, which showed that wage growth wages are still very sticky, and that's problematic for the Fed as it tries to bring down inflation to its target. Now, make no mistake, I believe strongly that we are in a disinflationary trend and we are moving in the right direction. We will get there, but it might not be exactly as the Fed would like to see it. Not every data point is going to fit that narrative, and so I fear that the Fed may hike rates another time. I don't think they need to, but the general theme should be that we are at or near the end of our rate hike cycle, which should be good for the stock market.
So then in terms of how much you're rolling in or out of defensive plays at the moment, how are you navigating that? And what are some of the questions that clients have?
Well, there are a lot of clients who got spooked last fall and want to know when is a good time to get in. They have been experiencing FOMO for months now. So that's one set of clients. Another set, of course, is very concerned that we could be in for a very significant downturn in the stock market. My view is that we're likely to see some consolidation because we had a strong rally, and because markets have to price in a more realistic view on when rate cuts will begin. And because I think we're just going to experience some hiccups because of uncertainty around Fed policy. So I think a defensive positioning in the near term could benefit investors. However, I anticipate there will be a shift soon as markets start to anticipate an economic recovery next year. And so a more risk-on positioning, a favoring of smaller caps and cyclicals, as well as a very diversified exposure to fixed income, including investment-grade credit, munis, high yield, makes a lot of sense in this environment. So really, we have to be rather tactical or just be well diversified and enjoy the ride.
And for a lot of people who were, pouring into treasuries here, trying to sort of hedge their bets here, how should they be thinking about approaching the treasury market at the moment?
Well, I think there has to be an understanding that there is real volatility in the Treasury market, and there are a number of forces converging that should keep yields elevated on the long end. But what I think is important is to take a step back and just see how much more attractive fixed income as an asset class looks today versus the last 10 plus years. We actually have an abundance of yield in a variety of different asset classes. So thinking less about the near term and thinking more about the opportunities there and having a diversified exposure to fixed income, I think makes a lot of sense for the long run.
Especially expecting that potential for a bumpy landing, as you've been saying there. Great stuff. We do appreciate you taking the time to join us this morning. A big thank you to Invesco Chief Global Market Strategist Christina Hooper. Good to see you.
Thank you, Rochelle.
Well, streaming giants have seen a mixed picture this earnings season amid a difficult ad backdrop and, of course, heightened competition. For some top takeaways, we're joined by Yahoo Finance's Alexandra Canal. Hey, Alex.
Hey, Rochelle, and you put it perfectly, right? We have seen a mixed bag when it comes to these streaming-facing media companies. We still have the biggie coming up tomorrow. Disney will report after the bell, but let's take a look at some of the top takeaways that we've seen so far. For me, number one would be that patience is a virtue for investors, especially when it comes to some of those revenue initiatives. And I'm going to call out Netflix here because we saw that company miss on revenue estimates with the outlook also disappointing. That initially caused a drop in shares immediately following the results. And that's despite the rollout that we've seen on that password sharing crackdown, in addition to the ad-supported tier. But both management as well as analysts on Wall Street have preached the long game here. The effect of those initiatives, that's going to play out in the quarters to come. So shareholders will have to practice patience there. But speaking of patience, we are finally starting to see some of those cost-cutting initiatives take effect, especially at companies like Paramount Global and Warner Brothers Discovery, which have been especially challenged over the past year. We've seen a ton of layoffs. We've seen, business restructurings, a dividend cut. But those are starting to play out with Paramount reporting narrower streaming losses. For WBD, we also saw free cash flow improve. So that's a positive there. But I want to turn to the negative because the advertising environment, that continues to be a very significant headwind. Linear ad revenue, that declined by double digits for companies like Paramount and WBD. There does seem to be some hope that the back half of the year we could see some improvement, but that ultimately remains to be seen. And then finally, one last thing I want to call out is that double strike in Hollywood. We heard every single media executive talk about this. They desperately want the strikes to end. They have reshuffled their release calendars to account for the strike, but currently there is no end in sight. And I think if the longer we see this play out, and if we continue to hear these conversations in Q3 and Q4, the outlook is going to be a lot more dim.
Indeed. And of course, Ali, earnings aren't quite over yet for the media giants. What can we expect from Disney?
Disney is going to have a bit of a challenge quarter, and there's a few things I want to call out here. We're going to see streaming losses that probably are going to continue to mount. The estimate here is for negative $775 million. That's due to a slew of heavy marketing costs. Subscribers are also expected to once again drop by another 2.6 million after their Indian Hotstar brand lost the IPL Cricket League. And similar to other media giants, that ad market that's expected to continue to hammer the bottom line and that linear network revenue, which we know is going to be closely watched on that earnings call. The one bright spot here could be the parks, but even there has been some question marks about the demand, especially as inflation remains high. And then on the film side, we saw disappointing debuts for The Little Mermaid, for Elemental, so that could come in soft. And overarching is what's going to happen with ESPN, right? Who are those strategic partners? How are we going to take ESPN fully over the top? So a lot of questions that likely will be asked on that earnings call. We'll have it all for you tomorrow.
I appreciate that very much. Our very own Ali Canal with that breakdown there on all things media and streaming. Thanks so much. All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at red across the board here. We're seeing the Dow now off about 360 points, or down about 1%. The S&P also down just over 1% there. Healthcare, the only sector in the green. Financials, of course, under the most pressure after that Moody's downgrade for banks. And the tech-heavy Nasdaq also down about 1.5%, or more than 200 points as well. Still waiting for that CPI data that will come out later on this week. Well, that does it for now. I'm Rochelle Akufo, but I will be back with you at 11 a.m. Eastern tomorrow, so I'll see you then.